The rate hikes that they've already done, we haven't felt the full impact of them yet. There's a lot of tightening in the pipeline.
We really should be focusing on the objective of the Fed, which is to get growth down, to get inflation down. And of course, the interest rate hikes are just a means to an end.
Now we're at a point where do we go back to the don't fight the Fed mantra?
There are different stories of what is happening to people when we think about the economy.
There is at least mild recession coming in the U.S., and there's also recession unavoidable for us in the Eurozone.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Hello, September. Where did that come from? You're going to keep singing, TK?
In September.
Let's give that a miss. Live from New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro, together with Anna this morning. Bramo, I'm told, he's going to be back on Monday, maybe. Futures down about 0.7% on the S&P 500. TK, what a brutal end to the month of August.
Surveillance break exclusive of Abramowicz Tuesday. Monday is Labor Day. John will figure that out at some point here. John.
No one told me, Tom.
It is... What?
No one told me.
Oh,
we get a day
okay.
off, no weekend.
Day off on Monday.
Nice,
yeah.
There we go.
Here we go. Here's where we are, folks, and John knows this. The markets are moving. Forget about a lazy August Thursday into Jobs Day tomorrow. John, every part of my launch pad on Bloomberg has an important story this morning. How about we start with a crushing new weakness in sterling?
Oh, Tom, a break at 116. 115.99 on my screen right now. And Tom, I was looking at the month-to-date performance last month, just yesterday for the month of August. Gilt yields were up, Tom, 94 basis points on a UK 10-year, and still pound sterling posted the biggest monthly loss going all the way back to late 2016, a move of 4.5%. So, Tom, high yields are not helping out pound sterling.
We're going to brief you on all these aspects, and we're also going to give you the research that's literally coming out in real time. John, HSBC moments ago, Christopher Hirche publishes, and he emphasizes, John, the longer tightening cycle that Europe and the United Kingdom need to deal with.
And more front-loading as well, Tom, particularly out of the ECB. We're teeing up 75, Tom. This is the real deal now.
Yeah,
everyone's getting on board. Bloomberg Economics early this morning talking about 75 on Thursday next week from this ECB.
Calendar check, September 8th. The date matters. Serena Williams will no doubt be hitting the ball at that time as well. John, this is really important, and you see it indicated in foreign exchange today. Yes, sterling and also Japanese yen. All of a sudden, 140 is here.
We've got to discuss China as well. Anna, I know you've been following that all morning out of London. Let's talk about it. Chengdu. 20.9 million residents facing lockdown. Yeah. What year is this, 22 or 2020?
Absolutely. When you read the details of what lockdown means in Chengdu for 21 million people, it sounds like a distant memory to many people in other parts of the world, but we know that's not the case in China. And big questions for the market around November. Does the policy change?
Does the policy change, Tom? How many times have you raised that issue, TK? The number one issue. How can we have an outlook on the global economy without an understanding of whether we have COVID-0 or not from the Chinese?
I'm going to channel John Hopkins here and just say it's hugely a science, and they're going to have to figure it out in their own original way. To me, John, what's the story here for our viewers and listeners in the West is it's not, I say I go to China, John, I go 845 feet from the Pacific Ocean into the Mandarin Hotel.
To the bar.
Okay, deep into China. Thank you.
Deep.
Chengdu is 845 miles from Hong Kong. That's what this story's about. It's not about the fancy Pacific Rim. It's about Greater China.
We'll pick up on that story a little bit more a little bit later. Let's pick up on a price action this morning. And good morning to all of you just tuning in. Equity futures down about 0.7% on the S&P to kick off the month of September. We're lower. We're negative more than 1 full percentage point on the NASDAQ. 4-day losing streak on the S&P 500. Over the last 4 days, we've declined by almost 6 percentage points. Yields unchanged on a 10-year, 318.33. Had a little look at 350 on a 2-year, Tom. Where are we right now? 347. Let's call it 348 on a 2-year yield. Euro dollar just about holding on to parity, 100.23, negative a third of 1%. And Tom, back in the 80s. The 80s in the mix on WTI, 87.80. We're down about 2% on crude.
We'll brief you on oil today as we go towards $2.99. We're not there yet, $88. And, of course, 86 level is the weakness that we saw weeks ago. Amrita Sen will be with us, and thrilled that on short notice, Francisco Blanche of Bank of America will join.
I missed that one, Tom. Looking forward to it a little bit later in the program.
You weren't at the 4 a.m. meeting because you slide in here at 5:52.
I wake up a little bit later than you now, Tom. I'm getting older. It happens. Phil Orlando joins us. Chief Equity Market Strategist
Phil Orlando
at Federated Hermes. Hey, Phil, this move, are we heading back to the June lows or not?
We think we are. Our macro policy committee met a week ago Monday after the equity market, the S&P 500, had just rallied by 19% between mid-June and mid-August. The market's perception was that inflation had peaked and was going to have this immaculate decline back to 2% in an eye blink. The Fed was done tightening. They were going to turn around and start cutting interest rates by the middle of next year. And we just felt that that was a head fake. And so we took some more chips off the table, a fortnight ago. And our view is that that 19% rally, we're going to retrace some or all of that over the course of the next month or two.
Phil, to channel the great Sir John Templeton, how do you determine when shares are on sale?
Well, we think they're on sale right now because the market got the fundamentals wrong. And I think Powell last Friday, while you guys were out in Jackson Hole, read the market, the Riot Act, and said, look, you've got the call on inflation wrong. You've got the Fed's process wrong. We're going to continue to hike interest rates, sort of channel our inner Paul Volcker until we get this right and get inflation back to our trend line. We think we're going to measure that process from an inflation standpoint in years, not months.
Right. Phil, Federated lived the collapse of Pittsburgh in 73, 74. I mean, the great Federated shop in Western Pennsylvania. You and I have seen stochastic inflation rises that rapidly become disinflation. Is there a risk that you miss a disinflationary trend?
At this point in the cycle, no, because it's not just one thing. It's broad-based, it's sustainable, it's sticky, it's wages, it's shelter, it's food, it's energy. The Federal Reserve, I think, knows that. I mean, what did Powell say last week? Yeah, we got a good July number, but that doesn't mean the fight's over. And I think, he's absolutely right. We could see energy prices rebound over the course of the next couple of months as Russia weaponizes energy, with Europe, as we've drawn the SPR down too much in the face of a hurricane season that hasn't developed yet. OPEC next week is talking about cuts rather than increases. Energy prices could rise and inflation could follow.
Okay, so there's a lot to talk about when it comes to commodities. Phil, sticking with how far stocks have to fall. I caught up with Mike Wilson yesterday of Morgan Stanley, and he was saying stocks have dropped on changing Treasury expectations and Fed expectations, but not on cuts to outlook yet. And he suggests that we've got another leg down because we need to be more realistic about what companies are going to be able to deliver. How much weaker does that story have to get?
Agree that we talked about the retracing back to the 3,600 level. We think earnings estimates in the second quarter started to come down. We think the third quarter could be worse in terms of sort of right-sizing estimates given the slowdown in consumer spending. This is going to be a challenging back-to-school season. It could be a challenging Christmas season. Remember, the consumer accounts for 70% of GDP. So our view is that earnings estimates, growth estimates need to come down, and I'm not sure that that's completely in the stock market right now.
Growth estimates need to come down, and we also keep an eye on all of the data, the inflation data, the jobs data and the like. How does the jobs picture factor into your models? When you look at what stocks do, how do you digest what's happening on the jobs front? Because we all know it's important, but what's the linkage?
That's a significant trend because the ability of the consumer or businesses, for that matter, to spend is a function of people being gainfully employed. You look at tomorrow's jobs number, consensus number at 300,000. Our internal models are showing about 170,000, about half that.
Wow.
You look at the ADP report we saw yesterday. The consensus for the ADP report was 300K. They came in around 170,000. Look at initial claims. We're going to get an update on that today. The claims are up 50% over the course of the last 5 months, about 80,000 claims. Historically, when claims increase by 50,000 or more off of their trough, you start the inflation clock. The recession clock. And the recession clock then indicates that the economy typically glides in a recession 12 to 18 months later. So we think we're looking at a recession at some point next year. We don't think that's in the market right now in terms of earnings estimates, economic growth, or share prices.
So with that in mind, let's squeeze this in. Tomorrow, if we get a disappointment, in a word, is bad news good news?
Bad news is not good news because look at the ADP report yesterday. We missed on the jobs number, But what was the wage inflation number? That number was north of 7%. That's a very dangerous combination, a stagflationary combination. Stocks have to go down, bond yields up, and we think stocks are going to be choppy for the next month or two.
What a tough time for the equity market bulls to hear Phil say that, Tom. Good news earlier this week was bad news, and apparently bad news is bad news.
Bad news, good news.
Phil Orlando of Federated Hermes. Lucky to have Anna with us this morning as well, Tom, because we need to talk about these strikes out of Germany. Anna, I was looking at Lufthansa. Have you seen this? To cancel almost all Frankfurt-Munich flights today.
Yeah. Back to this. I mean, they're in good company, though, I suppose, if you're looking at strike action. Certainly strike action here in the UK, within the aviation sector, other parts of Europe as well. And a lot of people talking about how this just gets tougher and tougher through the winter. The
economy minister in the FT, Tom, talking about German businesses shutting down because of energy and energy issues. How much of this are we going to see, TK?
We're going to see a lot more of this, John, and I want to channel the Irish Times. Thank you, Zero Edge. I'm doing this on the British Hour, folks. Anna Edwards, John Farrow.
Very cool.
It's very cool.
Well, we appreciate you being with us, Tom.
For a moment, let me straighten my bow tie out and pretend I'm at the BBC. John, Ireland, Galway. This is a set of miles directly west of Dublin. A little coffee shop, actually a high-end coffee shop, John, you and I can't afford. Poppy Fields Cafe, they don't do a full English, they do a full Irish with black and white pudding. Her utility bill was $10,000.
That's ridiculous.
$10,000.
It's going to put out.
You guys can afford it, though, with your dollars.
Tom, just absolutely...
Pity me with my pounds.
Brutal. Tom Keene, Anna Edwards, Jonathan Ferro this morning. Coming up, Jean Benvin at 7 a.m. Eastern Time out of BlackRock on the appropriate time horizon to get inflation back to target. John is just absolutely fantastic on central bank policy. We'll catch up with him a little bit later. Futures down 0.7% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former President Trump has accused the Justice Department of criminalizing his possession of personal documents. He made the allegation in a court filing seeking to bolster his case for a neutral third party to review documents seized by the FBI at his Florida home. The agents were investigating the presence of hundreds of highly classified White House records. In Alaska, Democrat Mary Peltola has defeated former Governor Sarah Palin in a special election for the state's only seat in the House of Representatives. That widens the Democrats' narrow majority, and it sets up a rematch with Palin in November for a full term. Peltola's support for abortion rights was seen as one of the deciding factors. In the UK, Liz Truss made a couple of eye-catching promises in her final pitch to become the next Prime Minister. Truss, who's favoured over Rishi Sunak in the Conservative Party leadership race, ruled out introducing any new taxes or energy rationing this winter. The next Prime Minister will be announced Monday. Bloomberg's learned that Hong Kong wants to end hotel quarantine in November. That would be just before a summit of global bankers and an international rugby competition. Public health officials are pushing back on a plan because of a resurgence of COVID cases. And Lufthansa says it will cancel almost all flights to and from its Frankfurt and Munich hubs on Friday. That comes after the German Airlines Pilot Union called for a one-day strike. About 800 flights and 130,000 passengers will be affected. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
My current view is that it will be necessary to move the Fed funds rate up to somewhat above 4% by early next year and hold it there. I do not anticipate the Fed cutting the Fed funds rate target next year.
That was Loretta Mester, but it could have been anyone on the Fed over the last week because they are all saying the same thing. Live from New York City, good morning to you. Alongside Tom Keene, I'm Jonathan Ferro. Bramo's going to be back on Tuesday, I'm told. Apparently it's a long weekend here stateside.
That's good.
I'm now dialed in and up to speed. Thank you, TK. Anna Edwards alongside us today. Here's the price action. Futures down about 0.75% on the S&P 500. On the Nasdaq, we're down a little more than 1 full percentage point. The hits keep coming. We can talk about the chip makers a little bit later. Let's talk about Chengdu. Lockdown in a city southwest China. 20.9 million residents. this is still going on. Just the hits the bulls are taking, Tom, across the board. It's every single morning at the moment.
And right now in Hong Kong, as I think we had on First Word News there, John, they're even talking about blowing up what is an attempt of major meetings in their financial capital because of COVID. Maybe
they make a move there. I want to talk about sterling as well, Tom.
115.82.
Weaker for a fifth straight day now.
Yeah.
Weaker pound sterling. And here's the number for you. 115.82, Tom, as you said. A 115 handle after the weakest month for pound sterling, going all the way back to 2016, and the weakest level going all the way back to spring 2020.
The heritage of Bloomberg surveillance, folks, is we adapt and adjust when the news changes. Overnight, we put a FX push on. We're thrilled to bring you now from Bank of America, out of Harvard and the University of Ken Rogoff, Thanos Vanvakidis joins us, Global Head of G10 FX Strategy. Thanos, honored to have you with us this morning. John's got a lot of questions on the dynamics of selected pairs. I want to go to the broader picture, which is you frame nominal GDP as being way too high, and then you bring it over to flows and balance of payments. Explain why recession changes foreign exchange.
Well, central banks obviously are focused on inflation, but they don't want to have a hard landing. So the market has this recession fear, hoping that this will turn the central banks less hawkish. However, if we assume that central banks effectively trying to balance these two things, that targeting nominal GDP, the truth is that nominal GDP growth in the major economies today is well above the historical average. Not only that, the forecast for next year is that it will remain well above the historical average. So it is hard to argue that the fear of recession will stop the central banks. So we continue focusing on inflation, and this is what is driving FX right now. This is why the dollar is strong.
Thanos, of August of 98, of the summer of 91 as well, there's a rollover to EM. I see loonie out to a 132. I see selected Asian currencies rolling over with ADXY out to 2004 weakness. Can this redound over to emerging markets?
So far, emerging markets, we can say in relative terms always, they've reacted well to the dollar rally. We have not seen the sharp sell-off that we have seen in past cases. Positioning also is not extreme. The market is short EM, but slightly so. We would be cautious as long as the dollar is strong, as long as the Fed is hawkish. It is hard to see a recovery in the MFX. A lot also depends on China. The weakness in CAY is affecting the rest of EM. So I will argue a cautious approach for now. Maybe EM will be a good trade looking to next year, but this will require the Fed to pause and US inflation to come sufficiently down.
So, Thanos, let me ask you about one currency that's very vulnerable then to strong dollar, and that is the pound, it seems. One of our colleagues, Simon White, writing today about the UK in his calculations having one of the largest twin deficits in the world. He puts that at 11% of GDP. He says that's a lot of kindness from foreign capital. How low does the pound get? He says thinking about parity is not off the table now.
Now, you have to go back to 1984 to see such a low level at the end of the Volcker tightening cycle. It has been like the perfect storm for the UK, a mixed macroeconomic policy picture, the highest inflation risks in G10, political uncertainty. I think and the Bank of England job has been extremely difficult. I think at this point, everybody is bearish selling for a good reason. The twin deficit that you mentioned is definitely one factor. I think what matters after we get the new PM next week is first, what we're going to see on fiscal policy. We need a responsible fiscal policy. Second, what are we going to see on Brexit? We need a compromise with the EU on the issue of the Northern Ireland deal. If on both these fronts we get a negative outcome, indeed sterling can weaken even more.
It can weaken even more. And what about longer-term inflation expectations, Thanos? The Bank of England out with its survey of financial professionals, over 4% in 3 years. This is not an inflation rate that's coming down in a hurry.
UK inflation has not peaked yet. We're actually having at 16% in January. I know that some of our competitors have it even higher. and we do have a recession in the UK. So compared to the rest of the G10, we clearly have the most severe stagflation scenario in the case of the UK. To a large extent, it has to do with labor market bottlenecks. We have a stretched labor market. Is not because the economy is doing well. To a large extent, has also to do with Brexit constraints. So this is keeping inflation high, despite the fact that the Bank of England has been hiking. Again, it's a very difficult policy mix. So bottom line, in the UK, we have not seen the worst both on inflation and on the recession.
Brutal. Thanos, thank you. Thanos Vambakidis of Bank of America.
Thanos, thank you.
Sterling 115.86. Here's my pledge. If we get to parity on cable, Tom, I'm putting in a transfer request and going home.
Well, these are serious things. I mean, John, don't make light of that. And
I'm not. I'm for real. Can you imagine, Tom? The American tourism right now into Europe
is booming.
Is off the charts.
Off the charts.
It is off the charts.
I
went there. All I could hear was American accents. Most people have heard the same.
Well, it's a dominance of the dollar until it doesn't work. And I want to make clear, I haven't done the work recently, John, but I'll do a technical study, log study of dollar to say, when do we get to a Plaza Accord when people say enough? We're not there yet. That's my major message.
When do you think we are there, Tom?
I haven't done the work. I got to look at yen, euro, and it's a way. It's a way. John, I got a major issue. Anna Edwards, you and I are here on the last week of the summer, Labor Day week. The closest I get to Valencia, Spain, is a damn orange at Whole Foods. That's as close as I get. Why is some of our staff on that island off of Valencia?
How do you pronounce it, Tom?
I can't pronounce it.
Ibiza?
Ibiza?
How do they like to
Anna,
pronounce it?
Anna's there every winter. Ibiza, Anna?
Ibiza.
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 Why
but
is
I don't
our
speak Spanish.
We need to ask Maria Tadeo.
I don't know, John. Why is our staff in Ibiza? We're not.
Special thanks to Lou Wang of Bloomberg News for breaking down the numbers for the month of August. Just truly brutal. Every single asset class, excluding maybe the FX space, Tom, because it's the US dollar that delivers some strength, but corporate debt, high yield, down on the month. Treasuries down on the month. Commodities down on the month. And then round it all out with equities down on the month. Equity futures down
John,
again, kick off September, Tom. We're down about 0.7% on the S&P.
Continue, John. It's too important. We got to keep with the data check. But the coordination here, the correlation rather, is tangible on September 1.
It was a tough month of August. Let's be clear about that. So we got 4 days of losses on the S&P 500. Previous 4 days down almost 6%, down something like 5.8% over just 4 days as yields start to climb higher. We took out the highs of the year of June 14th in the last 24 hours or so. Here's a snapshot of the bond board right now. Yields come back in about a basis point, backing away from 350 at 348 on a 2-year. But look at the work we've done over the last month in Europe. I want to take a snapshot of the UK and of Germany, and then look at the foreign exchange rate as well. Let's start with sterling. Gilt yields over the last month have moved more than 100 basis points over the last month. Right now, 286 on a UK 10-year. And Tom, yet sterling is down by more than 5%. Just think about that.
Right.
Over the last month, big move higher in yields, and yet still a much, much, much weaker currency. That's true of Europe too, with yields higher across the board there. That's problematic for these central banks, Tom, as they look to hike interest rates again and try and find a firmer footing in that FX market.
And very quickly here, John, on Italy, we're not through the June spread wideness, the difference in yield between Italy and Germany, but it's there. And I would suggest, John, that Italy is so fragile, they can't afford a spread breakdown.
And Tom, they're still going to hike maybe 75 basis points on Thursday. What can they do with the balance sheet to try and stop that kind of dislocation, fragmentation, pick your word, whatever they want to call it? Can they achieve that, Tom, given the backdrop, given the fact we're going into recession, it seems? Most people assume that's the case in Europe, and yet this central bank is determined to get rates even higher.
Yeah, the theories of 8 weeks ago sort of went out the window.
In the trash.
Yeah, in the trash. What we're going to do right now, folks, is drive it back to what matters for you, and that is the jobs report tomorrow, and of course claims, the weekly claims here in 2-hour time. Rubila Faruqi joins us, chief U.S. economist, high-frequency economics, always channeling the international views of Carl Weinberg. Rubila, bring it back to America and bring it back to what matters, which is in the ADP report, wages clocked 7%. What will we see on a wage spiral tomorrow?
Good morning. Thanks for having me. What we're expecting to see is, still elevated wage gains, maybe a slight tick up, still a 5 handle on year-on-year changes in average hourly earnings. The central point of this is what are we seeing on supply? And we really are not seeing any relief on supply. The participation rate has gone down. If you look at the civilian labor force, it's declined in 3 of the last 4 months. And that is where the stresses lie. And, without that and without any relief on wage gains, the Fed is going to remain focused on these things, and really the trajectory is not going to change at all, on tomorrow's numbers.
I find the analysis of a Fed action, and this goes to Kashkari of Minneapolis, but a Fed action to desire to move the unemployment rate higher to be way too simple. What's the complex part of that analysis that matters for our viewers and listeners?
Well, what we're seeing right now is severe dislocations in the labor market, right? We're seeing supply and demand imbalances. Does the Fed necessarily want to see the unemployment rate go up? No, absolutely not. That's not what central banks want. But, in this instance, we keep hearing about a tight labor market, and Chair Powell has said a labor market that is, tight to an unhealthy level. So that's what we're trying to figure out. How can this Fed orchestrate a rate hiking cycle where there's still positive growth, but unemployment goes up, but not by much. And I think the best case for them is that the demand side is so strong that you're going to see limited increase in layoffs. But I'm not really sure that is really possible.
Okay, Rabila, good morning from London. You talked about participation having dropped off, and clearly during COVID and in the immediate aftermath, it was obvious why that was. What's your analysis now of why participation is so poor? There are similarities with the UK market, and it's clear why it's poor here. But what's the story in the US?
What we're seeing is, elevated retirements that really contributed in a large way. We still have people who are suffering the effects of COVID. Excuse me. Who are still being affected by the effects of COVID. And you're still seeing, some challenges in terms of, prime age participation, in terms of childcare issues, health issues, elder care issues. So those things are still, persisting. And it's really not clear that we're going to see any relief. What we did see last time around was, as we were going into in 2019 before the COVID crisis, what we saw was a strong labor market did draw people back into the labor force. And that's what the Fed really is looking for, that strong job growth, high inflation, the lure of higher wages. Maybe that is where the relief comes in. But really, that's not something that is part of a base case scenario anymore. We've been expecting for participation to go up, and we really haven't seen it.
So if we want job openings to come down, it has to come from unemployment. It has to come from layoffs then, Rabila?
Well, not necessarily. We do think that demand for labor is going to go down. But, we're trying to figure out, why are layoffs so low? Is it just that demand is strong, or is it that companies are also reluctant? They've suffered, persistent shortages. So are they just hanging on to their workforce? Are they just reluctant to let go of their workers?
Rabila, here's the mystery question right now. What is non-farm payroll's normal number? It used to be 200, and we'd model out 150. We all got that wrong. That was a great wrong call of a decade. We're now rocking 280, 300,000, 320,000 per month. What's normal?
It's very difficult to assess what this labor market is, what normal is, where we're going to balance out. If we look at the numbers, break even is probably around 100,000, maybe slightly less.
Really?
But yeah, exactly. But again, we are basing our analysis on things that prevailed before the pandemic. So it's really difficult to assess. Right now, what we're seeing is, extremely solid job growth. And also, it's really not tying in with the concept of economy that has really, just flattened out in the first half of the year. But, what's appearing now is companies still, adding to their workforce, and the unemployment rate at historical lows, maybe even set to go down a little bit more, and, a Fed that is facing a huge challenge.
Rabila, a massive challenge, and not just the Fed, the ECB has a challenge of its own. Rabina Faruqi there of High Frequency Economics, getting you set up for the day ahead. We've got initial jobless claims a little bit later this morning, 8:30 Eastern Time. Mike McKee's going to break that down. Then ISM manufacturing a little bit later. The S&P Global PMI in the United States was pretty brutal, ugly. I think got ignored, Tom, because we're waiting for the ISM read, and we'll get that at 10 a.m. Eastern Time later this morning.
Well, we will. It's September 1. Let's remember that, folks. We've vaulted into the autumnal season. Thank you for the comments on Poetry Corner yesterday. John, when on 2 standard deviations, when you ride the rail, that's a trend in place. In the last 20 minutes, the trend in place on pound sterling is frightening, 115.62. For those not keeping score, John, that is life-changing for all of the United Kingdom.
Kit Jukes wrote about this morning, Tom, over at SocGen. It's becoming more and more serious by the day. He said higher gilt yields aren't so helpful when people see them as the price the UK pays to suck in huge amounts of money. And why it's great to have Anna with us today is because we need to talk about the leadership contest and who will be the next Prime Minister. And Anna, I wonder how much of what we're seeing is about what this next Prime Minister will have to do to offset some of this pain in the energy market.
Yeah, there are certainly. I was reading a note by ING this morning, and they were talking about fiscal stimulus and getting clarity from the next leader on what kind of fiscal stimulus it's going to be. Is it going to be targeted enough to not provoke the Bank of England into even more hikes?
Anna, you've got such skill on this, including your interviews with Lawrence the Cat over the last number of years. For our American viewers and listeners, I'm going to ask a question, and I say it with respect. Is Liz Truss like Theresa May?
Wow, that probably take quite a long time to answer. I suppose we have to think, well, is she going to be Prime Minister is probably for the American viewers the first thing, and she's up against Rishi Sunak. The polls do suggest that the selectorate, the small group of Tories who are going to vote for her, that she might get this, so she might be the person you need to think about. How long she stays in post, though, is interesting, because the Labour Party running up the polling, if you look at the polling for the next general election, which is a couple of years away, it looks like a tough ask for the Tories to hold on to power.
They face different problems too, Tom.
Yeah.
The number one problem, the only issue, is a single-issue government with Theresa May. It was Brexit. For this incoming Prime Minister, Tom, as Anna's talked about, the energy issue is just massive. The cost of utility bills in the UK huge. Businesses are already struggling. You've got consumers who will struggle later this year, Tom. It could get a whole lot worse. And what everyone's looking for the incoming government to do is offset that with fiscal spending. Got to fold that into the market moment that we're talking about at the moment, Tom. If they're going to offset that with fiscal spending, how accommodating is this bond market going to be? How wide open is it? Or rather, how closed is it?
To both of you, and let me go to you, John, and drive it forward. Like Churchill having 6 lives, can Prime Minister Johnson come back?
You think maybe make a comeback? There's no rules against it, Anna. He could make a comeback if he wanted to make a comeback.
I mean, it's been talked about, but at the moment, if you want to keep it in the here and now, it's about Liz Truss, it's about her fiscal policies, well, it's probably about Liz Truss and her fiscal policies, how targeted they're going to be, and she's committed to no tax rises, obviously. What does that mean for energy businesses? That's another key question.
And this is the number one issue, as Anna points out, Tom. We can't really think about Boris Johnson running for another term as the Prime Minister in the UK. Can we get to the end of the year first? And then, Tom, once we've got through winter, do we have to consider that we have to repeat this act, this dreadful act, next winter and the winter after?
John, I think we should do the British Hour more often.
Would you like to do that, TK?
I think we could.
You appreciate it. You love it more than I do.
It's great.
Futures down 0.75%.
West Ham.
The S&P.
Nate Shelley.
Someone corrected you yesterday. I saw that.
Oh, did they?
Yeah, I saw that. But Nate Shelley is Ted Lasso, Tom. And you don't spell it Nat. It's Nate with an E.
I didn't know that.
You knew that. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ruchika Gupta. Russia is holding major military exercises with China and India. It's seen as Vladimir Putin's way of pushing back against attempts by the US and its allies to isolate him from the invasion of Ukraine. More than 50,000 troops, 140 aircraft and 60 ships are taking part in the war campaigns in Russia's Far East. In China, the city of Chengdu is locking down its 21 million residents. It's a huge move in the vast western region of the country that had so far been largely untouched by the coronavirus. The lockdown could affect electronics and automaker supply chains. In California, blackouts have been averted so far in the midst of a heat wave that could threaten the supply of electricity through next Monday. The state called off its power grid emergency as night fell and it got cooler. The temperature reached triple digits in much of the state. Shares of Nvidia and other chip makers are lower today. Nvidia warned that new rules governing the export of artificial intelligence chips to China may affect hundreds of millions of dollars in revenue. The US is said to be concerned that these processes might be used by the military. And in tennis, Serena Williams has extended her stay at the US Open again. The 23-time Grand Slam winner upset number 2 seed Annette Kontaveit 7-6, 2-6, 6-2 in a second-round match. Williams has hinted the Open may be her last tournament. In an interview after last night's match, Williams said, "There's still a little left in me." Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm really optimistic about the substantial progress that's been made by our teams and the entire G7 toward making the price cap a reality. And as I see it, the price cap will advance our 2 key objectives.
The TK found the Treasury Secretary.
It was a sighting.
He was looking all weak. Janet Yellen, the US Treasury Secretary, just unbelievable, really, to have someone that well qualified. With so much expertise, Tom. And we barely hear from her
Don't get me going.
on some of the biggest economic issues in the moment. I
me-
won't get you going. Do you want to go? Sounds like you want to go. You're itching.
Okay, let me explain this. Yellen, what's great about Janet Yellen is when she gets angry, her voice changes to interior Brooklyn. It's really something to behold. She owns the high ground, John, on the analysis of the labor economy, and she owns the phrase slack. And she was courageous at a time in the great financial crisis to try to help Americans understand this new labor economy, and in a different way we see it right now, and I won't mince words. She's been muzzled.
The labor market expert. And we just don't get to hear from her enough. Tom Keene, Jonathan Ferro with Anna Edwards this morning. Bramo's going to come back after the long weekend. Futures this morning,
So
if you're
she
just tuning in,
says.
down about 0.75% on the S&P. On the Nasdaq 100, down 1 percentage points. The losses continue. Looking at the bond market, yields just about unchanged, up about a basis point at a 10-year to 320. Big moves at the front end. Looking at 350 earlier, then backing away. We'll have a look at that a little bit later. I want to talk about FX, and not just sterling, but also the euro. Sterling breaking down about 0.5% across the street now. Not just Wall Street, but across Europe. All the calls coming through for a 75 basis point hike, and yet here we are, basically at parity on euro dollar, negative 0.4%. TK tweet of the week from Jamie Barber out on Twitter.
It's a very good.
How Tom Keene would discuss FX dynamics with Ferro in Ibiza. There we go, Tom.
For those of you on radio, there's a gentleman with, count 'em, 1, 2, 3, 4 larger beverages of his choice waltzing across the beach.
Can we just clarify that that's Tom and not me? Because in Jackson Hole, Wyoming, we arrived to the diner. And I talked about this story last week, so allow me to do it again. Scene. TK and I walk in. Cowboys, literally real cowboys.
Real cowboys.
Sat there, having a meal. We walk in suits, looking very New York and out of place. Tom walks in with 2 martinis with olives in, and slams them down on the table and orders a steak well done. And I look around and think, steak well done? Who gets a steak well done, Tom?
It's Wyoming.
With 2
It's Wyoming.
martinis.
I would have had the
on
bison.
table.
I would have had the bison, but it was not in that restaurant, so I had to have the steak as well. You extend the beverages of your choice out, John. That was
Sure.
for a
Is that right?
lengthy dinner, as they say. Right now, we extend out to intelligence on hydrocarbons. Amrita Sen joins us, Director of Research at Energy Aspects. This is what we do on a Thursday. Francisco Blanche coming up on the macro. Amrita Sen on the dynamics right now. Amrita, which part of the micro matters now for weak oil? Which part are you studying?
China, I would say that's the number one concern in the market and a big driver of sentiment, not just in oil, right, across asset classes. But if you look at our balances, we have been, even here, we've been talking about, despite the weakness in European and kind of US demand, it's Asian demand that's stronger. And our expectation has been that China will be recovering. Now, that's not quite happening.
What is the dollar dynamic? And I mean this in dollar pairs, like dollar Philippine peso goes out to new Marcos Jr. weakness as well. And there's other selected currencies. But even away from dollar, Aussie yen shows maximum Australian strength. What does that mean for hydrocarbons in the Pacific Rim?
I mean, look, that's happening because, again, Australia and other commodity producers are clearly benefiting from such high commodity prices. It is to be expected, and that also means that commodity importers, which is the vast majority of Asia-Pacific countries, they have that added whammy, right? Not just of high outright energy prices, but also weak exchange rates, which means the import costs are higher. But having said that, outside of China, demand numbers are still very strong. If you remember, I'm sure you've seen it, the US numbers for June got revised up by 700,000 barrels per day. You know, every week we've had media headlines and other analysts hyperventilating about, weak gasoline demand. And we keep saying the weekly EIA numbers are honestly worth not very much because of the amount of revisions that go on.
And John mentioning the airline travel as well there. And I look at this, Aussie yen is really at a rare place back 20 years, out 1.5 standard deviations strong Australia. That shows the swings that we're seeing right now.
Yeah, well, Aussie yen, you're capturing the commodity story, you're capturing the interest rate differentials, aren't you there? Amrita, someone's clearly celebrating in the background of your shot, so congratulations to them for whatever it is they're celebrating.
It's our 10-year anniversary. It's literally...
Lovely.
It's 10-year anniversary.
Well, congratulations to you. Fabulous. Congratulations to you. I want to ask you about the end of December. When we get to the point where Europe is not supposed to buy any more Russian oil, how smooth can that be?
It's not going to be smooth at all, especially if we don't have clarity on the Iran deal. And for us, even if there is an Iran deal, the barrels don't really hit the market till January of next year. So this is going to be a very, very tricky time because Europe, or the EU particularly, has to get rid of at least another 1.3, potentially as much as 1.7 million barrels per day of Russian oil. And that is not going to be easy to replace because you've seen what's happened this summer when that volume of oil was still coming into Europe. Every single benchmark went to record highs in terms of the physical market, not necessarily the financial contract. Imagine another 1.4 on average we need to replace that. I'm not sure where we're going to get that oil from.
Amrita, thank you. Pretty scary speaking to people in the commodity market, Tom, when you get into the detail of this. Amrita Sen of Energy Aspects. First thing she said, China. Well, let's talk about China. 20.9 million residents going to be locked down in Chengdu, Tom. The date is the 1st of September 2022. Tom, we're still doing this? We're still doing this in China. That's the latest news.
And Chengdu is sort of a rockin' city. When you look at the fancy magazines, John, it's away 800 miles in from Hong Kong, and it's sort of like an in city. It's like the one place there sort of happening away from China politics and Beijing and all that. And here they are locked down. Can we say, John, it's the size of New York City?
Fourth biggest city.
Region?
Hey, Tom, bigger than that. 20.9 million residents. It's huge.
And you look, here's a headline just out, chart banner. Thank you so much for this. China, August, new home sales down 31%. Microdata, Leland Miller-like data. But again, it folds into what we see on the screen and comes right back to markets in America.
Well, the issues in China, Tom, are clearly going to be an issue in the commodity market. And Anna, I don't think you can have a call on crude or anything in the commodity market for that matter, including copper, of course, without a call on the outlook for China. I think that's almost impossible.
Yeah, absolutely. And then that has a knock-on impact to equities here in Europe that we see really clearly. So on a day like today, you see a basic resource stock sell-off. You see consumer products sell-off because all those luxury companies get another fresh reminder, another sort of slap in the face reminder of how tough things can be in China.
It's a punch in the face. For the Europeans, Tom, for mainland Europe, especially the Germans, leverage to the Chinese economy, leverage to Russian gas supply, all of that, TK, coming together in the worst possible way for that economy this year.
The singular salvation away from this legitimate gloom is a disinflationary trend when we see goods and even services ebb. That's the hope for September, John.
Let's hope we get it, Tom, without a big hit to GDP. Live from New York, this is Bloomberg.
The rate rate hikes that they've already done, we haven't felt the full impact of them yet. There's a lot of tightening in the pipeline.
We really should be focusing on the objective of the Fed, which is to get growth down, to get inflation down. And of course, the interest rate hikes are just a means to an end.
Now we're at a point where do we go back to the don't fight the Fed mantra?
There are different stories of what is happening to people when you think about the economy.
There is a at least mild recession coming in the US, and there's also recession unavoidable for us in the Eurozone.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Goodbye, August. Hello, September. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Anna Edwards. Bramo's going to be back, I'm told, on Tuesday after a long weekend. Futures lower, we're down 0.6% on the S&P. TK, we add to the losses of the previous 4 days.
It's an important market day here. You know, we're doing the Time of Wonder Act, the Robert McCloskey book, John. Everybody coming back lazily from summer, forget about it. The screen does not show that into tomorrow's jobs report. We are focused on the international and on currency dynamics. And John, to have Jean Boivin with all of his expertise at the Bank of Canada on here in moments is important.
Looking forward to that, Tom. The dollar stronger, of course, through the months of August, taking down sterling, taking down the euro in and around parity. But TK, what a month for risk assets in the month of August. Stocks down, commodities down, corporate credit down, high yield suffering, treasuries down. Take your pick. Brutal month, particularly the end after Jackson Hole.
And convexity, or fancy talk, acceleration in bond yields. First thing I looked at yesterday, John, first thing I looked at today, the German 2-year yield legs up as we see Asian currencies leg down to new weakness.
It has surged over the last month. And we'll pick up on that theme in about 30 minutes' time. We can pick up on the theme of the ECB. We've talked a lot about the Federal Reserve. Anna Edwards, look at this for a list. Goldman Sachs, Bank of America, JP Morgan, Capital Economics, Bloomberg Economics, all looking for 75 basis points from this ECB next week.
Yeah, absolutely. It's hawk after hawk, isn't it? Is Philip Lane the only? I was going to say the only dove standing, but I don't know if they stand flying. But he's certainly been the only major voice out with fairly dovish comments, flagging Italy risks, flagging that if you go slowly with hikes, you can correct course. But others aren't giving us those views. They're just hawkish.
And Anna, willing to do this going into a recession. I keep saying potentially a recession. Do you just consider that a given? Because most people looking at this situation see it that way.
Yeah, I mean, a lot of guests do flag that they see recession coming, but still big questions, though, John, obviously, about how long those last and how deep it gets. And frankly, a lot of it comes down to the weather and how therefore, the economies manage to sort of weather the weather, if you like, how they can cope with the cold. As gas, yes, it's stockpiled, but that's not going to be enough.
We've said a few times, winter has already arrived for the Europeans, Tom. We talked about Europe, the US, let's do China. 20.9 million residents locked down in Chengdu. If you thought things couldn't get any tougher, Tom, there's some extra fuel for the fire.
There's a war in Europe. We forget about that. And frankly, it's not funny right now. On two fronts in Ukraine, John, it's an active war this last week of Asia. It's not a war in China. It's a war on common sense and science. And it collapsed overnight in Chengdu, 800 miles in from the Pacific Rim.
Tom, we're taking it back to the Cold War in Europe. We're taking it back to 2020 in China. We've got a pandemic, got a war, got the United States stuck in between, trying to raise interest rates, get demand softer, get inflation down. Tom, that's a lot of conflict. A lot of conflict to try and digest, process, and work out what it means for this market.
Currency will adjust part of the inflation. It's a partial differential on inflation dynamics, but nothing will bring inflation in, John, like weak growth, the global slowdown we see. And that's what you heard this week from, example, David Rosenberg.
That's the number one question to ask, though, Tom. What is the GDP price we've got to pay to get inflation lower? What's the price?
I agree with that, and to see dollar Canada out near 132 is absolutely stunning today. Why don't you bring in our guest, John, or do we need to do data?
I was going to do the price action first, Tom. You know how this show works. Welcome to Bloomberg Surveillance. Futures down 0.6% on the S&P. On the Nasdaq, we're lower by 0.9%. Yields just a little bit higher, not much higher. 320 earlier this morning. Right now, 319.46. Backing away on crude, down by more than 2 percentage points. 87.45. Talked about sterling being weaker. The euro is as well, down a third of 1%, negative a third of 1% on euro dollar to 100.19. Jean Boivin with us now, the head of the BlackRock Investment Institute. Jean, I've been following your research. You're writing, you know I do. And I'm pleased you're writing on something that I don't think enough people are thinking about. The appropriate time horizon to bring inflation back to target. with the circumstances, the backdrop that we have at the moment? John, what is it, and why aren't we talking enough about it?
There used to be, I'm old school, I guess, but there used to be two key principles underlying monetary policy. One was that, you need to be thoughtful about dealing with trade-offs and being deliberate around that. And the other was about being forward-looking. Those two principles seem to be pretty much absent from the current discussion. And I think that speaks to the horizons here. We're dealing with a massive shock that is more of a supply in nature. And that leads to, we're just talking about how much GDP costs we need to go through. We think the GDP cost is pretty significant. If we want to bring inflation down to 2 quickly, it's 2% of GDP, recession type we need to go through in short order. That's a very brutal cost. And nowhere in the discussion right now you see this explicitly being acknowledged, being discussed, or hearing from central banks on how they want to navigate that. We used to think that in the face of these shocks, it would take longer to bring inflation back to target. Nobody is really making this argument.
Jean, I want you to talk about the asymmetries there of strong dollar versus weak dollar. Now we have strong dollar. I'm not going to ask you for a level on your Canada, on loonie at a 132. But what is the asymmetric differences of a bold, strong dollar versus a weak dollar reality? We don't have that right now. We have strong dollar. It seems new.
Yeah, I think we always break that down in terms of what we think is the key driver. Think of the currency being driven typically by two broad regimes, in my view. One is interest rate differentials, and the other is the broad risk-on, risk-off global sentiment. I think we're in a world now that is mostly driven by overall risk sentiment. So I see the gyration being about whether we are risk averse, which tends to provide a bid to the U.S. dollar, and that when that wanes, we see some weakening. So I think we haven't seen the full implication of this world yet. The pressure it's going to put globally. Canada is one place, but like emerging markets. So that hasn't really played out yet. And right. I think that's part of
the picture here. I wanted to go there because Aussie yen is out 1.5 standard deviations, which is a rare occurrence. Tell me of the Pacific Rim risks that we face now, or are they in some way protected from the tumult in the Western world?
No one is protected, but I think there's homegrown kind of headwinds, right? That we see. We were just talking about lockdowns in China, so the pole of growth there certainly has been challenged. We've been neutral on the region for some time now as a result of this, and I think a global recession or slowdown that would be significant will have some rippling effect there as well. So I think we see these part of the transmission of the slowdown through the APAC pole of growth.
Jean, good morning from London. What are the, good afternoon even now, time catching up with me. What are the monetary policy lags that we need to keep in mind when you're talking about the tightening of policy as you are there, and you're talking about the time horizons over which we should be correcting inflation? What are the lags in policy that you have in focus? I mean, I'm thinking here about the US.
So we, in general, I think we're still in the world where like monetary policy works with at least a year to 2 year of lag. 18 months is the number you would get from typically if you pin me to one number. I think that still is the case in this world, and I would argue that it might be even more delayed because the interest rate here is not the cure for the source of the inflation we're experiencing. So we will need to basically crush the interest rate sensitive part of the economy, which is not the culprit of the inflation at this point, to really offset the other inflation pressures. And so that needs to work its way through the system. None of the rate hikes we've seen so far are really containing inflation. We're getting now to the phase where it's going to be restrictive. It will have an impact, but that's going to be about a 2024 story, really. And that's why I think we see a lot of optics of central banks talking tough on inflation. But this is really optics and politics of inflation, not really the economics of inflation.
So, Jean, let's talk about what it would take for you to get bullish on this equity market. Jean, what do you need to see?
We need to see a couple of things, right? I think now we're equities and generally are reflecting a path of policy tightening that is more or less in line with what we think will materialize. So, Jackson Hole has, I think, crushed any hopes of backing off from hiking intention soon. I think equities are starting to reflect that properly. The part that is not yet in the price is the earnings story. And, we think we're going to see a recession early 2023 in the US, but it's happening earlier and deeper in Europe. And that is not reflected in the equity price. So to turn bullish, which will be the big call to make over the next few months, is when we're going to be able to start to look through the size of this recession and have more handle on this. And the second is when we get to the point where we get some sense that central banks are waking up to the damage that is being caused and are starting to take that into account. So when we're going to start to see sign of that, I think we'll be now in a position to really talk about a version of a pivot or slowing down or stopping. And once we have visibility on this, then I think that's going to be a more positive backdrop.
We'll catch up soon on it. John, really deeply thoughtful stuff. We appreciate it. Jean Bavon there of the BlackRock Investment Institute. Just a couple of things to look out for in the day ahead. I'll pick two for you. Jobless claims coming up at 8:30 Eastern Time. Mike McKee, as ever, is going to break that down for you. The estimate on jobless claims this morning, 248K, up from 243. That's the estimate in our survey, so look out for that. Then later at 10 a.m. Eastern Time, the team's going to break down the ISM manufacturing number. And a little bit later, the estimate there, 51.9. The previous read, 52.8. Remember, the S&P Global PMI, dreadful. We'll see what the ISM looks like. And then, Tom, it's on to payrolls tomorrow. You mentioned the estimate of 300K. I can tell you it's come in just a little bit to 298.
There's a little bit of a change there. John Sterling out to new weakness moments ago.
I saw that, Tom. Lower the session, 115.54. Coming up, Marvin Lowe. We'll catch up with him at around about 8 a.m. Eastern Time, so let's call it 50 minutes away. He joins us from State Street, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. Former President Trump has accused the Justice Department of criminalizing his possession of personal documents. He made the allegation in a court filing seeking to bolster his case for a neutral third party to review documents seized by the FBI at his Florida home. The agents were investigating the presence of hundreds of highly classified White House records. In Alaska, Democrat Mary Peltola has defeated former Governor Sarah Palin in a special election for the state's only seat in the House of Representatives that widens the Democrats' narrow majority, and it sets up a rematch with Palin in November for a full term. Peltola's support for abortion rights was seen as one of the deciding factors. Friday's U.S. jobs report has the potential to tip the scales towards a third jumbo-sized interest rate hike later this month. It's one of the last big releases that Fed officials will have in their hand before their mid-September policy meeting. There's already been a wave of data that point to a resilient consumer and high labour demand. In the UK, Liz Truss made a couple of eye-catching promises in her final pitch to become the next Prime Minister. Truss, who's favoured over Rishi Sunak is the Conservative Party leadership race, ruled out introducing any new taxes or energy rationing this winter. The next Prime Minister will be announced Monday. And Lufthansa says it will cancel almost all flights to and from its Frankfurt and Munich hubs on Friday. That comes after the German airlines pilot union called for a one-day strike. About 800 flights and 130,000 passengers will be affected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Hearing from central bankers and academics around the world, the clear priority was bringing inflation down. And that really lines up with my own priority, being president of the Dallas Fed and as a policymaker. Our number one priority has to be to restore price stability.
Fantastic to hear from Lori Logan of the Dallas Fed, the new president, making her first address, Tom. Very, very cool. Congratulations to her. Live from New York City this morning, a good morning with Tom Keene and Anna Edwards. I'm Jonathan Ferro. Bramo's going to be back with us on Tuesday. Looking ahead to payrolls. This is the number we're looking for, 298. The previous number, 528. Going into it, futures down about 0.5% on the S&P. On the Nasdaq 100, down 0.7%.
It's terrible.
Yields unchanged on a 10-year, very close to 320, 319.84. Dollar stronger.
John, it's just terrible.
Euro weaker, euro dollar negative 1/3%. Crude down 87.70, down 2%. What's terrible, Tom?
Fully employed America. I mean, it's just,
Well, this is the issue.
Terrible.
I'm with you, so let's discuss it calmly. How do they convince people? And how many times have I asked this question, Tom, in the last week? 50 times? How do they convince people higher unemployment is the price worth paying to get inflation down? How do they do that? Now, at the moment, with unemployment at 3.5%, the objective might not sound as controversial, but once they get there, Tom, and you start to see unemployment climbing into year-end, which is in the forecast of this Federal Reserve, what's the reaction then?
I think the real estate issue is tangible. Other than that, I would suggest second-order conditions will solve the problem, including if price comes up, it works to bring price down.
I hope that's the case, Tom. Without a big GDP hit.
You know, Anna's like,
that's the case.
Anna's saying, like, why did I sign up for this show? You know.
Most people feel that way, TK.
I wasn't saying that. So I was just reflecting on what we heard from Jean Boisin just moments ago, where he was talking about how long it's going to take to bring inflation down.
Exactly,
So,
that's
yes,
it, Anna.
It's really important, isn't it? How long is it going to take?
Yep.
And drawing out the different drivers of inflation. And in this particular context, when some of it comes from supply, you weigh down on demand, but that doesn't fix supply.
I would just suggest, John, that the British do that better than we do. The British do X-axis analysis way, way better than the heritage of U.S. economics. Let's digress to politics right now. Jack Fitzpatrick pulled the unfortunate straw. He's going to talk about second choice voting. But first, Jack, before that, I've got to go to Alaska and say that the geography lesson for today is Kansas, the Hudson River north of New York City, and now the great state of Alaska with one congressional vote. Is the vote in November just about abortion?
It is a huge factor going into the midterms. The Alaska race does seem like some evidence of that. The Democrat who just won that special election, Mary Peltola, played up her opposition to the Supreme Court ruling pretty significantly. It is a little hard to draw inferences nationally from a ranked choice race where you had a Democrat in Alaska beating someone like Sarah Palin, who is a bit of a lover or hater politician and didn't get a lot of second choice measures. But it's a huge factor, especially for any Democrat running in the midterms right now.
Jack, I can say this on the British Hour of Bloomberg Surveillance with Ferro and Edwards here today, but ranked choice or second choice voting is un-American. It's something new for us. And obviously the Democrat won the second time around, going from 40% to 51%. Did Palin lose the election because of ranked choice voting?
Potentially. One, the Democrat, Mary Peltola, got the most votes for the first pick. If it were not ranked choice voting and they went to a two-person runoff, it would raise the question of could Palin consolidate the vote that went to the other Republican, Nick Begich. In this case, people listed who their second choice was, and only barely more than 50% of the people who voted for that other Republican gave that second choice to Palin. While the rest were split between either giving it to the Democrat or saying none of the above.
Jack, just because of time, beautifully explained. Anna Edwards, this is more crazy than British politics.
Yeah, that might be. I was actually drawn, Jack, to some really interesting statistics over recent weeks that showed just how many women are coming forward to register to vote and how the number of women outpaces the number of men coming forward to register to vote. So if you're looking for, across the United States, the impact still of that Supreme Court ruling is there, isn't it, in that statistic? And some of that is in some swing states, so this could still make a difference.
Oh, it can make a very significant difference. I'm sure it will make a difference. It's a hugely motivating issue for women, for Democrats. It's not something that plays to the same degree of motivation for Republicans. There have been other statistics. You look at some of the generic ballot polling that's looked good off and on since that Supreme Court ruling for Democrats. The question is, how good news is it for them? Where does it help them the most? Is it in the key swing districts? And are we talking about Democrats actually having a chance at winning the House, or probably more likely losing by a narrower margin and holding on to the Senate? But it's a very significant thing in some key races. Nationally, that is probably the biggest factor playing in favor of Democrats and motivating Democratic voters heading toward the midterms.
Jack, thank you. Jack Fitzpatrick there down in D.C. That's the domestic politics covered. We need to talk about the international issues. A report came out from the UN yesterday evening, a much anticipated report, and it concluded something deeply distressing, Tom, which we've discussed many times over the last few years. The UN says that China has committed, quote, serious human rights abuses. They went on to say that their assessment found, quote, patterns of torture or other forms of cruel, inhuman or degrading treatment or punishment. Of course, you're all familiar with the region of Xinjiang and what's been happening with the Uyghurs and other Muslims as well. The report went on to say, Tom, that there was a broader campaign of rights violations that, quote, may constitute international crimes, in particular crimes against humanity. These allegations also levelled by the previous administration and the current one as well, Tom, here in the United States. This was Beijing's response to all of this. They're calling this, quote, the lie of the century. They're going on to say that it wantonly smears and slanders China. And the foreign ministry calling the report, quote, Tom, illegal, null and void. But I do wonder how this administration responds to this, Tom, in the coming days, and I haven't seen a big response to it just yet.
I think the simplistic response is we need our iPhones from China. I mean, this is about the fallback on this, John, is the globalization and trade relationship, as Catherine Mann, now with the Bank of England, brilliantly put, the dysfunction of our trade relationship with China. That's the raison d'etre for why we're doing this. I would point out it is the bipartisan issue of Congress. It's the. That was the
multinational response to things in Russia over the last 10 years, Tom, and then things broke.
And 20
we need our
years
gas
ago.
from Russia, and here we are. And it's going to be interesting to see how multinationals respond to this too. Live from New York, this is Bloomberg. What a choppy start to the month of September. Good morning to you all. Live from New York City, futures down 0.5% on the S&P. On the Nasdaq 100 down 0.7%. Over the last 4 days on the S&P, 4 days of losses that total 5.8% on the S&P 500. For the month of August, commodities lower, high yield credit lower, treasuries lower, equities down, brutal across the board. Thank you to Lou Wang of Bloomberg News for breaking that down as yields push higher and eat into this equity market. Up about 60 basis points to the front end through the month of August on a 2-year. Breached 350 a little bit early this morning. Broke through that level. Right now backing away by a basis point or two on a 2-year. 347.89. Yields problematic for the equity market. I can tell you yields doing nothing in Europe to help the FX market. So let's take a snapshot of that in Europe. Sterling and the euro over the last month. This is over the last month. Let's pay attention to this. Yields have broken out by more than 100 basis points on a 10-year gilt. Yields have broken out on a 10-year bund by about 80 basis points over the last month. And typically you'd think with those kind of moves that maybe you'd get some kind of currency stability. Here's the problem. You haven't. Euro dollar negative about 2.5% over the last 30 days, Tom. Sterling cable at 115.69, down 5.5%. We have just had the worst month on sterling against the US dollar going all the way back to late 2016, even with a massive move in yields. The why? We're talking about how are you going to attract that foreign capital into the UK?
Exactly.
Do you need higher yields, a weaker currency, or both? If this new government, Tom, needs to offset some of that pain because of the energy problems.
And John, what's so important here, I'm going to channel Robert Sinch 101 from years ago at Bear Stearns and Bank of America. There's a point where you switch from interest rate analysis to flow analysis. Are we there where these flows in and out of UK based on worry really matter?
Kit Juicer Sock, Jen. Stephen Gallo of BMO, the former Deputy Governor of the Bank of England, Charlie Bean, speaking to us just yesterday in the London team. They're starting to think about those issues in a bigger way. That's the UK. For Europe, Tom, we're talking about 75 basis point hikes from the ECB, according to Bank of America, the likes of Goldman, Morgan Stanley, take your pick, Capital Economics, Bloomberg Economics, all starting to lean in that direction, Tom, and still we can't get any real traction in the currency. They're two really important things we need to look out for through the next couple of weeks, Tom. The ECB on deck next week, the Bank of England soon after.
Well, and also the economic data as well. These inflation numbers, John, are unimaginable.
Tough, and that's why they want to make a move and do something about it with higher interest rates, but the currency story is not helping, that's for sure. That's across asset price action. Let's get you some single names and movers. We can do that, I'm pleased to say, with Critty this morning. Hey, Critty.
Well, good morning, John. You're talking about the currency story. Well, it extends into Asia as well, specifically circling right back into those chip names, and that's really where you're seeing the pressure this morning. NVIDIA in particular, of course, the major tech heavyweight and the major player in the chip space, down about 4.5%, dragging down the entire chip sector with it. And here's why. There is a triple whammy. Some of that is going to be the currency story. It is, Tom. There's no other way to say it. The second is going to simply be there is that China lockdown in Chengdu specifically, which is going to be a major tech hub. So it's going to start to affect the supply chains of a lot of major American tech companies. Once again, really pressuring this sector. But really, I think the cherry on top of the pretty bad Sunday for NVIDIA specifically is the warning that they gave. You now have the U.S. government putting restrictions on exports, chip exports, especially artificial intelligence related to China. If a company like NVIDIA now wants to access the Chinese consumer, they have to get special permission from the U.S. government. That warning, they said, could actually hurt their bottom line by hundreds of billions of dollars in revenue. So a lot of pain in NVIDIA, and it is rippling across, to Advanced Micro Devices, down about 2.5%. Micron, the largest memory chip maker in the States, also under pressure, down 1.7%. You even see it in the names like Intel, for example, which, by the way, just broke ground on a new manufacturing facility in Ohio, something that President Biden actually attended himself. Still not immune from the pain, down 0.9%. Right. Bed Bath & Beyond, Tom, a favorite of yours, I'm sure. When you talk about the retail sector, they have this massive turnaround plan. Liquidity is still an issue, though. A 27% drop in yesterday's session after they said they might actually sell quite a lot of stock. The hangover is not over for that stock, down 3% in pre-market trading, but a pocket of green, Tom, when you look at 3M specifically. Now, what's interesting here is the shares are actually up about 0.4%. This follows them talking about massive job cuts and job losses. What's interesting here is ordinarily on the surface, that sounds like bad news, but this is a similar reaction we saw in Snap Shares as well when they announced a 20% cut to their workforce. The idea of cost-cutting measures is something a lot of these stocks are being rewarded for.
Critty, thanks so much. Greatly appreciate it this morning. Futures negative 13. We had a 27 handle on VIX. Gets my attention. This morning, we're looking at oil. Francisco Blanch scheduled to be with us. Amrita sent earlier. And on this lazy August summer week, well, it's not. We are thrilled to bring you this morning Ian Lingen. He is head of U.S. rate strategy, BMO Capital Markets. His morning note is definitive on Wall Street. Ian, what nobody's talking about, and I want you to do this for John Farrow and the real yield that will be filmed tomorrow in Panavision. It is the inflation-adjusted yield creeping up. What are the ramifications if the real yield breaches through its previous high?
Well, I think that the real yield story is a very important one given where we are in the cycle. We're seeing break-evens start to compress, which means compensation for investors to move further out the curve is going to remain under pressure. If you get real yields back at the highs, that means that financial conditions are going to be tighter. It also means that the Fed's actions are becoming more and more relevant to the real economy. So that's certainly something we've been watching very closely.
Is the real yield as it moves, and frankly, after the jobs report, and when John films in Panavision on Friday, is the real yield something that can change what Chairman Powell and the Fed do?
I certainly think it can shift the cadence of their rate hikes, but it won't define whether or not they're going to continue to hike at every meeting for the balance of this year.
How far do you think the Fed goes here, Ian? And I ask this because I saw in your notes you talk about how they're more likely to overshoot than to show restraint. When do we get a sense of that overshoot?
So I think at the next Fed meeting, you'll get the updated SEPs or the dot plot, the projections. The Fed will tell you where they think terminal is. And at that point, all else being equal, I suspect they're going to err on the side of targeting the 3.75 to 4% range by the end of the year. More importantly, though, they want to hold that as long as they can. And we've already heard that rhetoric from Jackson Hole and some of the other Fed speakers. They're going to get to terminal, and they're going to hold it ideally through 2023, if not into 2024. The big question becomes, will the other financial markets allow them to do that? And we suspect the answer is ultimately no.
Okay, so it's a hike and hold, not a hike and cut. What's the read across from other international bond markets? Because we've been talking about whether there's a risk premium increasingly coming into sterling bond markets, to gilt markets. We're talking about the challenges facing the Eurozone economy. What's the read across from these markets into treasuries?
So in terms of how it impacts the treasury market, there has been global upward pressure on rates, but to some extent, if you have the ECB going 75 next week, that's going to impact global commodity markets a bit more and to some extent take the heavy lifting burden off of the Fed. So in an environment where one might foresee the Fed getting above 4%, say to 4.5%, if everyone else is hiking as well, then that makes it a bit easier for the Fed to target a lower terminal rate and then keep it there for longer.
If I look at the Lehman Barclays Bloomberg Total Return Index series, the fact is we're rolling over, price down, yield up. If we breach the lows, is it like equities where bonds in aggregate have a convexity trend of fear? Do bonds, Ian, we don't know this because we haven't had a real bond market like this. Mm-hmm. Do we get convexity and fear and sweat and catharsis acceleration in bonds like we're used to talking about in equities?
So I don't think that we're going to see a wholesale capitulation comparable to what we often see in the equity market. And a lot of that comes down to the fact that the people or the institutions that hold treasuries are major central banks, they're major buy and hold investors, insurance companies, et cetera. And so they don't have the same, or don't necessarily have the same incentives to get out and realize those losses that an individual might have. They just take the loss. Exactly.
Ian, I want to squeeze this in before you run because we're lucky we've got you here in New York. Tom and I now have got a long list of people who think we've seen the highs on a 10-year for the year. Steve Major of HSBC, I can think of a ton more. Ian, at 320, what's the risk around that view?
I still think that we have seen the yield peaks for the cycle, but it looked a lot more of a compelling argument when we were at 251 just recently. It's certainly going to be an interesting next 2 or 3 weeks in the run-up to the Fed. If we break 350, it will be between now and the 21st of September, and that'll be a massive buying opportunity for a lot of investors.
There we go. Ian, thank you. Ian Ligon there of BMO Capital Markets. Tom, the high of the year on the closing basis, 347.33. That was on a 10-year. That was back on June 14th. Right now, just south of 320.
Now, John, I'm bringing in the duration. I'm bringing in the level here on my triple leveraged all cash fund. I mean, I've just got a shortened duration.
You putting some money to work, Tom?
No, I'm putting it to sleep.
You're putting it to sleep?
Yeah, I'm just running away.
Okay.
I'm shortening duration of my cash account.
What are you doing? How much shorter can you get? How much shorter can you get? Have you seen what T-bills yield, Tom?
I don't know. You know, I'm just hedging out here.
I think someone's trying to get us the first word news.
Tom, that wasn't for you, John. That was for me. That was for me. Can you do that again in the studio? We need that here. We're waiting here. John, I'm waiting. Come on, give me a first word. Let's go.
Cue.
Let's go.
For anyone on radio, that's a visual cue for us.
Yeah, it's a visual cue. Yes, on radio, they're in our ear. Tom, shut up. And on TV, they put up the first word banner.
They're not doing that again, Tom. I'm going to whip through the price action. We're off the lows. Things get a little bit better. We're down about 0.4% on the S&P. On the NASDAQ, Tom, we're down about 0.6%. Yes.
John, the interns are gone. I'm looking over here. The interns are back in college.
They're back in college. That's
very
cool.
some Tang, and I can't get it.
We've had enough Tang already. Did you see the US Open last night? Serena
I did. I was not there.
Cool.
You know, DeGrom was pitching. I didn't want to go up.
Are you watching a baseball?
No. When I was there for Emma, I went up to the top of the stadium, and with binoculars, I could watch the Mets while I watched her go down in flames. You can't do that with Serena. You know, I get.
I'm conflicted with Serena, Tom. I want her to do well. I want her to win. At the same time, the tickets are so expensive that if she drops out, then maybe they get cheaper. Very selfish, I know.
I mean, come on, they're outrageous, John.
She was brilliant yesterday. It's good to see her on form like that. But yes, Tom, they are outrageous. Absolutely outrageous. Futures lower on the S&P by a third. Things improve on the NASDAQ, down just 0.5%. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The largest US airlines are now making more explicit pledges on how they'll treat passengers when they cancel or significantly delay flights. That comes after pressure from the US government. The Department of Transportation has unveiled a website publicizing airlines' plans. The carriers are promising meals and hotel rooms in some cases for disruptions. In Jackson, Mississippi, a water crisis is making life miserable. Many of the city's 150,000 residents have been waiting in line for water to drink, bathe, cook and flush toilets. The city's water system partially failed this week following a flood. Local authorities blame decades of deferred maintenance. President Biden says he wants to provide federal support. And in China, the city of Chengdu is locking down its 21 million residents. It's a huge move in the vast western region of the country that had so far been largely untouched by the coronavirus. The lockdown could affect electronics and automakers' supply chains. And a new report says that UK households are set for the biggest squeeze in living standards in a century. The Resolution Foundation warned of a 10% fall in real disposable incomes over 2 years unless there's a support package of tens of billions of pounds. Soaring energy bills have driven inflation well into the double digits. And in tennis, Serena Williams has extended her stay at the US Open again. The 23-time Grand Slam winner upset number 2 seed Anna Kontaveit 7-6, 2-6, 6-2 in a second-round match. Williams has hinted the Open may be her last tournament. In an interview after last night's match, Williams said, "There's still a little left in me." Global News, 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To me, the most costly mistake we will make is if we get fooled thinking, oh, we've got inflation licked. Now let's go cut interest rates because the economy is showing signs of weakening. So the way to deal with the lags, for me, is just to get somewhere and sit there until we're really convinced that we've got inflation licked.
Just an absolutely brilliant conversation with the Minneapolis Fed President Neil Kashkari on the Bloomberg Odd Lots podcast with our friends Joe Weisenthal and Tracy Alloway. Tom, it's one of those conversations where you're surprised that people are surprised by what someone's got to say. Happy with the reaction to Jackson Hole and not excited by the market reaction to the last Fed meeting.
It's a rare and beautiful thing, John. She's here for what? John, is this like a 2-hour interview we're doing?
I think this is 2 hours.
we could do it now.
Pushed into like 10 minutes, Tom.
Here's what you need to know. In 1961, a young boy named Mick Jagger went to the London School of Economics and went down in flames in mathematics. Tracy Alloway followed on from Mick Jagger and actually got through the rigorous math course to get your way along at LSE and went on to a sterling journalism career, including working with Mr. Weisenthal on Odd Lots, and she joins us here on the aerospace engineer from Minneapolis. Does Kashkari know what he's talking about?
Well, the interesting thing about Kashkari is that he's transformed from the Fed's biggest dove into the biggest hawk. And he says it's because he's been watching the data. Data didn't come in quite the way he thought it would. So like Keynes, he changed his mind, right? So that's the interesting thing about him at the moment.
I look at this, Tracy, and what's so important here is what do the monetary pros think? It was Clarida, and now it's maybe John Williams and a few others. What do they think of presidents shooting from the hip?
That's quite a question. What I will say, Jonathan kind of alluded to this about the interview that we had with Kashkari, where he was talking about how he welcomed that stock reaction, stocks actually going down following Jackson Hole. I cannot believe that markets were so surprised. You have had a Fed and you've had central bankers on the Fed talking about how they want financial conditions to tighten for months and months and months. And a component of financial conditions, of course, it's stocks.
Financial conditions. They need stocks lower. They need spreads wider. Tracy, what was the biggest piece of pushback you had against that? Because I was watching all the commentary over Twitter, the people who were surprised, and you and I who were surprised about them being surprised. What was the biggest piece of pushback that you saw from this interview?
There were a lot of people talking about how the Fed said the quiet part out loud, but these are the same people who would make jokes about how the Fed only wants to push up asset prices for the past 5 or 10 years, right? If the Fed only wants to push up asset prices, then they can have situations where they also want to push them down. Now is arguably one of those times. The Fed is explicitly telling you that it needs financial conditions to tighten in order to get a grip on inflation. The components of financial conditions have got things like mortgage spreads, bonds, and of course, stocks. So I'm not entirely sure why people were so surprised.
Hi, Tracy. Yeah, it was a really fascinating conversation that you had with him. I mean, if you want tighter financial conditions, you mentioned the other ways you get tighter financial conditions. Do we have a sense of which of the elements the Fed would prefer. I mean, we've got Kashkari saying stocks doesn't mind if they go down, but that's not quite the same thing as saying, you really want them to drop.
Yeah, well, I think the big question in markets right now is why, even with all this Fed jawboning, why financial conditions haven't tightened more. Why are investors, I guess, dragging their feet when it comes to this issue? Does the Fed have a preference on exactly what moves the most? I think it doesn't want to see anything break in the financial market. It doesn't necessarily want to cut off capital inflows. It doesn't want to see a seize up in the credit market, which is something that we almost saw over the summer. But that said, it still wants something to happen. And the longer this sort of tension, the standoff between investors and the Fed goes on, the more likely we are to see a big move from the central bank that actually gets us there.
And that was really interesting in the context of what we saw from UBS and others around credit markets just in the last 24 hours, saying credit markets are simply not pricing in enough a chance of a recession. We saw this from UBS. They said credit markets, by their analysis, are just giving it a 25% chance when actually they think it should be pricing in for a much higher chance that we get a recession in the US. Maybe this is the mismatch that you're talking about.
Yeah, this is kind of the amazing thing about the credit market at the moment. So you look at something like high yield spreads, so risk premiums on junk rated bonds. These are the things that are supposed to show concerns about a looming recession first. And we are far, far from those levels. I think it's something like 800 basis points on the high yield index. We're at like 450 right now. And then you have other people who are saying, well, don't look at junk bonds because the junk bond market has changed so much over the years. It's mostly BB rated debt now. It's far from what it used to be. Look at something like leveraged loans. These are the floating rate loans that junk rated companies took out en masse for the past 5 years. They're supposedly very risky, or there are some people in the market that think they're very risky. And so those are where the first signs of stress could show up. But even if you look at the S&P LSTA leveraged loan index, we're at something like 95 on the cash level now.
Right.
85 is generally considered distressed.
Tracy, when you were at the Convent of the Sacred Heart in Tokyo a million years ago, you used to sneak into the Imperial Bar at the Imperial Hotel. The Frank
How
Lloyd
did
Wright
you
bar.
know that?
I knew that. Rumor has it. What does Japan do? As JP Morgan says, there could be a 140, 145 yen. Everybody's standing around in the West going, no big deal. I don't buy it.
Well, this is the other big question that I have about the Fed right now, and I actually asked Kashkari about this. What happens to the rest of the world when you are raising rates at the fastest pace in decades? We've already seen the dollar appreciate considerably. We haven't necessarily seen U.S. financial conditions move as much as we might expect, but we know that financial conditions elsewhere in the world are tightening. That seems like a problem for me when you're talking about economies, Europe, emerging markets, to some extent Japan, that are now experiencing an energy crisis and everything is priced in dollars. The Fed is heaping more pain on the rest of the world. The U.S. economy is relatively resilient right now, but at some point you're going to get that boomerang effect. That's what Kashkari called it, where it comes back and it impacts the U.S. economy.
Interesting. Tracy, it's been too long. Is the podcast out right now?
It's out right now.
Fantastic.
Check out Odd Lots. I was talking
here's
with
the promo. Gotta have it. Come on,
squeeze it in. That's the feed.
I was talking with Tom, and he was actually our first guest when we launched the podcast 5 or 6
years ago. The show went up from there, John.
Downhill from there, or uphill from there?
Up there.
Uphill.
I would say uphill. Yes.
Tracy Alloway, Joe Weisenthal of Odd Lots.
You guys could do Ferro. You
Just
could do
brilliant.
a whole football.
That is really downhill, Tom. I think they want some expertise on markets, not on football at the weekend.
We could do joint things. We could all four of us travel.
We could do a combination.
London, and
we could do a joint tour, a podcast
John,
tour.
I just figured out with Tracy's Asia experience, Party Congress China, Bramo.
You're trying to recruit people to that, aren't you?
Joe, Tracy.
If you can guarantee me that I don't have to do a hotel quarantine, Tom, I'll consider.
The 5 of us on a Peace Hotel looking over the Boon, the 5 of us, Weisenthal would have to wear a suit and tie.
I don't know if Joe's going for the suit and tie these days. Tom.
He isn't. No, he threw them all out.
Much more relaxed kind of look now. Much more relaxed kind of look. He's got longer hair now too, TK.
Yeah, no, it's.
They need to update the photo. Check out Odd Lots. Truly just absolutely brilliant from Tracy.
And it's done really well.
It's done fantastically well. Just a deep dive into some of the major issues at the moment. And the reaction to that conversation with Neil Kashkari, Tom, everybody picking up on it. Savita Subramaniam at Bank of America had this to say. Jackson Hole raises the risk for equities this fall. They still underprice the policy risk. The Fed finding inflation through financial conditions means that risk asset rallies both force and allow them to hike more aggressively. This we know, Tom, and it's becoming obvious for a lot of people in stocks right now.
It's in play, and it'll be in play here in 35 minutes, John's claims, and then on to the jobs report tomorrow.
Claims just around the corner. That's in the next hour. Futures lower by 1/3% on the S&P 500. On the Nasdaq, down by 0.6%. Live from New York City. Good morning. This is Bloomberg.
Baseline inflation story plays out, and if you get some weaker wages, then I think we're in pretty good shape to have an expansion.
The key here is, does the consumer hold in September?
I think there are huge disparities still out there.
We're not really seeing the growth impact yet.
I wouldn't be surprised if equity markets go down a bit further from here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most important Thursday. Forget about the dog days of August. The markets are on the move, and in this hour, they will move further. We've got data, we've got productivity data, and John, unsaid at 10 a.m., the first look at August.
Yeah, survey on manufacturing. That's going to be important, Tom, from the ISM. Looking forward to that. Before we get there, jobless claims in about 30 minutes. Then on to payrolls Friday, TK 298,000 on payrolls. I guessed a little bit early this morning. Do you remember that conversation, Tom? I said, is good news bad news? Is bad news good news?
Don't get me going.
He said, bad news is just bad news, John. It's not good for the equity market right now.
Well, we see it now with the data, and of course the data in Europe is grim. Anna Edwards in for Bramo this morning, and thrilled she's with us, particularly with her view on the linkage of the political debate in the United Kingdom into the grim data. John, let me start with you. You go to Anna. John, sterling says all.
A whole lot weaker, Tom, even with a big backup in yields this morning. It's a break of 116, a clean break. 115.52 is the low. And Anna, right now, we're just above those lows at 115.70. Walk us all through the challenge that the UK faces and the whole of Europe faces too.
Yeah, I mean, in the UK case specifically, a little leaderless at the moment, waiting to find out who becomes new Prime Minister. We get that during your holiday on Monday. So that clears the political vacuum. But big questions over fiscal policy then follow because, of course, of the cost of living crisis, the cost of energy. We all know that conversation. And twin deficits in the UK put sterling front and centre.
John, frame the inflation number over there. We're looking at 8-9% here. Am I right that Goldman Sachs published a 22% statistic earlier this week?
Possibly, Tom, could be the peak. After Citi said it might be something like 18, and after the Bank of England said it could be, well, something in the region of 13 percentage points, Tom. It's going to get worse, not better, in the view of so many people. And that's the difference between the UK, Europe, and what's happening here in the United States. In the minds of many in the US, we've already seen the peak inflation story. In the minds of many in Europe and the UK, for that matter, Tom, the peak inflation story is still in our future, not in our past.
John, let's go into the data here, and I want to take the 2-year yield in Germany, legging out to new higher yield, and fold it, John, into a data check starting with foreign exchange. All of a sudden, dollar-yen nears 140.
Inflation up, yields up. Rates are going to be a lot higher. We're looking for a 75 basis point move from the ECB next Thursday, yet still you can't get that euro strength. Just sitting in and around parity on euro dollar, negative 0.5%. That's a weaker euro in the mix again today. And Tom, that's the problem for this ECB. A higher interest rates, bullish or bearish, for this currency. What does it mean for this currency, Tom? Weaker or stronger in the face of higher interest rates, when the big issue right now is what happens with the price of gas, electricity, and how deep, not if we get a recession in Europe, but how deep. It's about how deep it will be, Tom.
There have been Augusts where we have recalibrated. And this August, this strange August, and yes, it was a strange Jackson Hole, we in spades recalibrate into the fourth quarter of 2022. Marvin Loeb provides leadership at State Street Global Markets. He is Senior Global Macro Strategist. I'm going to say, Marvin, you need to rip up the script on September 1. What's the new script look like?
I mean, the new script, you know what? I actually don't think the new script is that different than the old script. I kind of think back to what we were talking about before the June FOMC, which for whatever reason prompted the risk rally. We had yields somewhere around here, if not higher, and we were expecting a transitional data story that wasn't going to be clear until we got into the fall. We're back there at this point. So it's really thinking back to what really scared us in June and kind of realizing that certain economies are worse off, whereas the U.S. is still kind of moving towards the story that we really have spent a lot of time on since the beginning of summer.
Marvin, we don't need things to be great or good. We just need them to be better than expected. Do you think they can be? And what do you need to see to get bullish this market?
You know what? I think we do need to get a sense of the inflation story and how it evolves, because that ultimately tells us when the Fed is going to get comfortable slowing down. You know, they've been saying that the data is volatile, inflation is especially volatile, and they don't really have a handle on it. They're trying to put numbers on it. But until we get a better sense of how that plays out over the course of the next couple of months, which, you know, for the most part, the market's expecting fairly aggressive improvements on the inflation front. If that proves correct, I think that you could start putting toes in the water.
So, Marvin, we're all trying to work out what's the price we've got to pay to get inflation lower. Do you see that reflected in the price of high yield right now in earnings expectations?
Yeah, no,
how low is that bar?
I think credit markets, in particular high yield market, has somehow been able to avoid dealing with that situation. I don't think it's priced in. You know, from a spread perspective, we're 200, 300, 400 basis points away from what you would expect in a recession. And, you know, we've been saying that the Fed ultimately, through its action, at a minimum, is going to cause a mild recession. And the longer this goes, the harder that recession gets.
Marvin, good to see you from London. What is it that wakes up the credit markets to what you're suggesting there then, Marvin? What are the data points that mean that the credit markets see those spreads widen?
Yeah, I mean, certainly there's been a repricing of credit the way we've had a repricing of a lot of the other risk assets over the last couple of weeks. So that it is starting to wake up. I think it's default. You know, ultimately, defaults have not increased as much because financial conditions, for the most part, still remain either, you know, average, if you will, over long-term perspective, but certainly quite loose given how much tightening we've put in the system. Once we start getting defaults because those financial conditions get tighter, then really the shock has gone across the bow at that point.
Marvin, we spent a lot of time today talking about the Fed, rightly, and a lot of time in recent weeks talking about the Fed and its driving markets and sentiment. Today we get a wake-up call, though, from China, where we see another city lockdown, just, in inverted commas, 21 million people sent into lockdown in an area of the country that's not seen much COVID. A stark reminder of one of the big risks that still hangs over here. How much of a threat is that?
I mean, I think it's absolutely significant. You know, obviously the importance of China in the global economy, you know, can't be overstated. You know, in a lot of ways, they are pursuing a philosophical approach that we'll need to reverse. There's no way that they're going to avoid that, and they're going to be doing that at a point when the world is slowing down. So you have risk from that perspective. But certainly, the longer they go on with this, the more challenging it is. And there are clear correlations between China and the emerging markets. That's pretty well established. But even from a global perspective, when the rest of the world is slowing down, it really does highlight the challenges we have going into the next couple of months, quarters even.
Marvin, what do you make of the current consensus that for the US economy, that if we get a recession, it will be short, it will be shallow? I keep asking that question, Marvin. I just want to try and better understand the risks around that view, given that the consensus has been wrong so many times over the last 2 years, and this cycle is moving so quickly.
Yeah, absolutely. You know what? It comes down to the jobs market. So, you know, every first Friday of the month is the day that we certainly get all energized in terms of that number. It is incredibly important because a jobs market that's creating, even if we slow down to 200, 250,000, that's a good number before the pandemic. That creates wealth, and I think that ultimately has kept some of the expectations around a recession more mild. What we heard from Jackson Hole is that there might be pain, or there likely will be pain at the household and business level. You know, I think that directly speaks to the jobs market. And unless we get a lot of people coming back into the jobs market, you're going to need to see very low growth and/or negative numbers to kind of get the Fed where it wants to be.
Marvin Lowe of State Street Global Markets out of Boston. Marvin, fantastic to catch up. Looking ahead to payrolls tomorrow. We haven't talked about it yet this morning, and you might have missed it late last night, but we heard from 3M, another company planning to eliminate jobs as part of a broader cost-cutting drive. Tom, you talked about how corporate America would adjust. You talked about how cost cuts would come Here they are from 3M, and this is the quote that they put out in the statement from the company. 3M is taking decisive actions to position the company for continued growth while also adjusting to the challenging macroeconomic environment. And Tom, that means job cuts.
John, I'm biased on this. My mother was a child of Minneapolis and Chicago long ago and far away. This is not the Minnesota mining and manufacturing of my childhood. It has been a challenge company with a 6.1% total return over the last grinding 10 years. They started cutting jobs 3, 4, 5 years ago from like a 96, 97,000 level. And it's just a continuation with an excuse now of all the turmoil that's out there.
As we prioritize our investments and resources, Tom, we will be adjusting on an ongoing basis the roles and responsibilities needed for future growth. And that future growth picture at the moment, Tom, looks a little bit softer.
It's just been a real industrial exercise. But, John, to that point, we spent far too much time, and Bloomberg Surveillance is guilty of this. We love to talk to Dan Ives and others about Apple, Mark Gurman, and that Apple, throw in one other stock, John, Snap or whatever I can. You know what? This is about industrial America and service sector America, and they're being buffeted with this slowdown.
I wonder when we start to see that in the actual data, Tom. In payrolls.
It lags. It's a good
lot
question.
Of companies make these moves. And Tom, I'd go further. I'd say the state of the labour market, the leverage that the employee had versus the employer last year has changed. That's for sure. So when you hear the banks, the likes of Goldman, the likes of Morgan Stanley saying, let's get back to the office.
What do you think?
Jeffries this morning, Tom, saying they need everyone back in the office on a consistent basis. This is what I think. I think relatively speaking, and I stress relatively speaking to last year, Tom, I think you've got a little bit less leverage this time around to say, you know what, no,
I agree.
I'm staying home.
I agree.
Do whatever you
with
want.
that
I'm staying
statement.
home.
I agree. I don't know if Ann agrees. We'll talk to Ann about that in a bit here. But yeah, I think it's, John, it's real. It's a real debate. I'm thinking, should I go from 3 days a week?
To what? 4?
4, 5?
You know you're meant to be doing 5 right now, right?
I thought I was doing 6.
Well, I'm doing about 3.5 at the moment. Tom Keene, Anna Edwards, Jonathan Ferro. Bramo's doing 2. He's doing 2 days a week all summer.
We're gonna do sleep from office.
Lisa's back next Tuesday from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former President Trump has accused the Justice Department of criminalizing his possession of personal documents. He made the allegation in a court filing seeking to bolster his case for a neutral third party to review documents seized by the FBI at his Florida home. The agents were investigating the presence of hundreds of highly classified White House records. In Alaska, Democrat Mary Peltola has defeated former Governor Sarah Palin in a special election for the state's only seat in the House of Representatives. That widens the Democrats' narrow majority, and it sets up a rematch with Palin in November for a full term. Peltola's support for abortion rights was seen as one of the deciding factors. In the UK, Liz Truss made a couple of eye-catching promises in her final pitch to become the next Prime Minister. Truss, who's favoured over Rishi Sunak in the Conservative Party leadership race, ruled out introducing any new taxes or energy rationing this winter. The next Prime Minister will be announced Monday. And problems for Microsoft's planned $69 billion purchase of Activision Blizzard. The deal will be sent for an in-depth review unless the company offers remedies to address the UK's watchdog's competition concerns. Regulators are concerned the combination will lead to fewer choices in the gaming sector. Microsoft says it's ready to work with them on their objections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
China, I would say that's the number one concern in the market. Our expectation has been that China will be recovering. Now, that's not quite happening. Outside of China, demand numbers are still very strong.
Amrita Sen with one word, China. The Director of Research at Energy Aspects says China locks down 20.9 million residents in Chengdu. Just another headwind to the global economy for us all to consider. Live from New York City, good morning with Tom Keene and Anna Edwards this morning. I'm Jonathan Ferro. Bramo back after the long weekend. Equities lower by 0.5% on the S&P 500, on the Nasdaq 100. Down 84 points. We're down 0.7%, just about off the lows. Yields pushing higher, back through 320 on a 10-year, 321.92. Let's call it 322 on a 10-year, up 2 or 3 basis points. TK, did you see The latest news in California yesterday.
Oh, yeah.
They've got to take these measures to conserve energy. They're telling everyone to get away from gas vehicles, get to electric. And ultimately, you've got to do that by 2035. And then yesterday, Tom, telling residents at one point not to charge their electric vehicles because it's stressing the grid too much.
So what we're going to do is stop. We're not going to talk to Francisco Blanch, head of global commodities and derivative research, of the price of Brent or this, that, or the other. We're going to talk about the greater energy moment that we're in. It is a crisis in Germany. It is a crisis in Anna Edwards' United Kingdom. And it goes to, as John mentioned, the grid. Francisco Blanch, I've seen endless studies. Davos, you could fill up the promenade with all the fancy studies about what to do. Why can't we fix this energy crisis? Why can't we fix the global grid of electricity and hydrocarbons?
Well, Tom, you've kind of brought in a lot of issues into a single question, but I think the best answer that I can give you is the uncertainty that we have created in terms of what the future demand for energy looks like. If you start with the International Energy Agency's scenarios for 2050 for decarbonization, there's a huge gap between the business as usual scenario, the aggressive scenario, or the net zero scenario. And it's really hard to tell which way we're going to go into 2050, whether global coal demand is going to collapse, or maybe it's going to hold in a little bit, or maybe oil demand will collapse, or maybe it won't. And I think the same thing applies to electricity, right? So all of that's kind of really difficult, make it very difficult for companies to make a decision in terms of how to allocate their capital. And then, of course, we've had the Russia-Ukraine situation, which has made things a little worse.
Surveillance research, Francisco, is that you and Savita Subramanian are actually on speaking terms at Bank of America. She has provided stunning leadership in the quantitative aspects of ESG. When you have a cup of coffee with her, can you state that ESG is here to stay, or is it dead with the war in Ukraine?
Look, I mean, I think ESG is here to stay in most people's minds. I think that's true for investors, it's true for governments. Which I think ultimately means for a lot of the pieces of the energy sector you're talking about, like how you fix them, I think you're going to have to end up with a lot more government involvement. We've seen that already in Germany and in France with the takeover of Uniper and EDF. I think we'll see just a lot more participation of governments generally. Even when you look at oil and gas investments, OPEC this time around, particularly the Gulf Cooperation Council countries, have actually been leading investment relative to other parts of the world. So I think governments are just going to get a lot more involved in the energy space on a forward basis to essentially get us through the current mess.
Francisco, do you think climate change has become a convenient excuse for some of the challenges we face right now, when a lot of it is about investment, a lack thereof, a lack of planning? And I understand we've had a big shock this year, but I think that's a convenient excuse in the minds of many people, Francisco, that we've tried to transition too fast, too quickly, and move away from fossil fuels without a more resilient plan in place. Which one is it?
Look, I mean, I think the climate change data that we're getting every day really points to the urgency of doing something about the carbon emissions that we have on a daily basis. We are warming up the planet very quickly, and we've seen that in Pakistan more recently with pretty catastrophic outcomes. We've seen a complete drop in water reservoirs in the Alps as well, which is leading to lower water river levels across Europe. So I think climate change is real. We're seeing one of the biggest droughts. I think you guys put that out recently. In Europe, we have the biggest drought in 500 years. So you're having a lot of data points out there that really suggest that the climate change is happening very quickly, and that's further straining our energy system as it would. Now, I do think we wouldn't be in the current situation if we hadn't been losing as much Russian energy as we have over the course of the past 6 months, right?
Francisco, can I ask you about proposals in Europe to cap gas prices and what you think of that? I spoke to a guest earlier, and this goes to what you were saying there about relying on Russian energy. I spoke to a guest earlier who said she doesn't want to see a cap on gas prices. She thinks fiscal stimulus should just be given to those who are struggling to pay, because with a cap, you don't have quite such a strong price signal, and we need that to make the transitions and the investments that you talk about.
I think that's completely wrong. I mean, I think you need to put a bit of a cap on the price of gas, and you need to remember, the price of gas is setting the marginal price of electricity, right? So let's say that if the price of electricity is 1,000 euros a megawatt hour, you're not really incentivizing anything at that price point. And there is a clear market failure that I think should encourage governments to take action here. And again, it's pretty simple stuff. I mean, you're above 200 euros a megawatt hour. Most European industrials cannot operate, right? So when you're at 1,000 euros a megawatt hour, this is past beyond the point of demand destruction. And it's also past the point of supply increases of renewable energy in the future. You don't need 1,000 euros a megawatt hour to encourage wind or solar power. You need a much lower number. So I think governments are taking the right steps to try to cap the price of gas. And again, it's going to be a subsidy for sure. But I do think that the consequences of not tackling the current shortage of gas in Europe could be devastating to both consumers and industry over the course of the next 6 months. Remember, you're probably destroying about 5% of European gas and power demand every month with this kind of price levels that we're seeing here. So
these are just massive numbers, Francisco, that I don't think we've still fully internalized and recognized how bad this is going to be. Francisco Blanch there of Bank of America Global Research. Francisco, you're one of the best. We appreciate your time. In the FT yesterday, they put out a story, Tom, 15 times the level of previous years. That's the price of electricity in Germany. And they were talking about how German companies, manufacturers, some of them, Tom, just shutting down.
John, most of America's complacent on this, and this goes back, I think, of the legend Dan Fuss at Loomis Sales, where we borrow electricity under stress, like from Quebec. Texas is our only analog, John, really, to what's going on in Europe.
Can I just say thank you to Francisco, Tom, for bringing up Pakistan? What's happening there is just so sad. They're calling it a monsoon on steroids. It's been absolutely brutal. Live from New York City, jobless claims coming up next. Mike McKee in the seat is going to break it down. This is Bloomberg Surveillance. Jobless claims out in a couple of seconds. Mike McKee's going to break that down for you. I'm happy to say he's in the seat, live from New York City this morning. Good morning with Tom Keene and Anna Edwards. I'm Jonathan Ferro. Bramo's going to be back with us on Tuesday, I'm told, after a long weekend. Anna will be back with you on Monday to guide you through the leadership contest, the outcome of that in the UK, who will be the next Prime Minister, all that good, exciting stuff. Jobless claims coming in the right direction, Mike McKee. Downside surprise, the right kind of downside surprise. Run us through it.
Well, it depends on what you're trying to accomplish, John. Jobless claims fall to 232,000 in the last week of August. And that's kind of weird in the sense that the Fed is expecting jobless claims as part of unemployment to rise as they tighten financial conditions. And that's not happening. Continuing claims go up to 1,438,000 from 1,415,000. So a little bit of a change there. And that's important because of people who are getting unemployment for the first time, more of them are staying on it. Not a significant amount, but that's something to keep an eye on. The other number out this morning is productivity and unit labor costs, first time for the second quarter, and it is still bad news. Non-farm productivity down 4.1% after falling 4.6% in the first quarter. That is not good news for the economy overall for obvious reasons. The Fed would like to see that go up. As productivity goes up, you can use fewer workers, and right now we're using more workers and producing less with it. Unit labor costs up 10.2%. That's a bit of a decline from the 10.8% we saw in the first quarter, so that's a little tiny bit of good news. Labor costs going down just a little bit, but overall, good news on the labor front in a way, and bad news on the productivity front.
You framed it correctly, Mike, and I'm with you, but I think we both refuse to call a downside surprise on jobless claims bad news.
Yeah.
It's good news for the labour market. It's just problematic for this Fed, who's looking to get inflation down. And, Mike, that's just evidence, perhaps, that this labour market's still tight.
It is still tight. I mean, you look at the JOLTS report we got earlier this week, you have over 11 million jobs still out there. people who are losing their jobs are able to find new ones. So it's an interesting situation, and we're wondering when the Fed is going to bite.
Mike, I'm going to make a joke about this, but it's not a joke. Dollar legs stronger here. That's a fact off of this. And John and I have been making jokes all this morning. I know you just got into the office, Mike, but the basic idea here is there's a prisoner's dilemma. I'm not going to go into it now because of time, but to pick 2 of the 4 boxes, there's bad good news or good news and the other opportunities as well. Which is this for Jerome Powell?
Well, I would say it's probably bad good news, in the sense that it suggests that somewhere out there is their goal, and they're not there yet. And you can see why people maybe have taken the markets have moved too much for today, because tomorrow's going to be definitive. But what we can do is go from there and
what
see.
Do you
Yeah, Anna.
What are you expecting, Mike, tomorrow? What are you looking for tomorrow? Given what we've seen here and how the markets are responding, where does that leave us for tomorrow?
Well, the change in non-farm payrolls has dropped down to 298,000 for the estimate. I mean, that's a 2,000 difference. I'm not sure it makes a whole lot of difference. So anything in that range would probably be considered good or average, even though it's much higher than we were seeing before the pandemic. But anything above that would certainly be a shock to economists. 528,000 last month was roughly double what they had expected. And if you get that again, then the market is going to obviously think that the Fed is going to have to tighten further, and that will have an effect on where they go from there.
Mike McKee, thank you, buddy, as always, breaking it down for us. TK, this is a really interesting economy right now. I find it absolutely fascinating. Just how strong is this economy? How much damage needs to be done to get inflation down, and how high do rates need to go to get this economy down just a little bit softer, Tom? Because the labour market doesn't seem to be responding to this yet. And I get that it's lagging. I get all of that. But yields are higher, Tom, at the long end on a 10-year, 3.25.
I want to focus on that before we get to our good guest. John, sterling breaks down to new weakness seconds ago to a 115.50 level. And I'm looking at the real yield. John, I mean, you're going to have to blow up your show on Friday, your late taping as we dive into the 3-day weekend. 0.78% on the positive 10-year real yield is extraordinary. These are important events for the economy.
We breached 350 a little bit earlier, Tom. I know you noticed that one. Did you see the Luke Cower quote earlier this week? Can I share it, Tom?
What, on lobster chowder?
Yeah. Let me read it to you, though, because I think it's pertinent to the conversation we're having right now. Just got back from yoga. This is Luke's travels. Teacher kicked off the class by telling us the same boiling water that kills the lobster softens the potato. And that naturally got me thinking about the Fed. The Fed thinks the economy is a lobster, but right now, Tom, it's a potato. Now, if you caught up with that, then congratulations. But, Tom, I think that's a really important thing to think about when it comes to this economy. Just how resilient is it?
Luke Kawa is a value add for the Union Bank of Switzerland. Very good. Blarina Uric is with us right now. She's going, why am I doing this? She's with T. Rowe Price, and we welcome her this morning. Blarina, what does a dollar signify? If you're sitting with Chairman Powell at the Eccles building and you see new dollar strength in a summed condition, what does it signal to him?
Well, I think we should think about what does a stronger dollar do for the U.S. economy and take it from there. If you're a central bank that is struggling with very high inflation, some of it from goods that are imported externally, you might think a stronger dollar is going to help bring that inflation down at the margin. It might not be the main force driving easing in inflation pressures, but certainly the Fed could use any help from any front it can get at this point. A stronger dollar also is going to be challenging for the U.S. manufacturing and net trade in general. So it does soften the outlook for the economy as well. But then more broadly, if we were to take a signal from this strength in the dollar, it's telling us that on a relative basis, the outlook for the U.S. economy might be stronger than for its trading partners. And the Fed is on a path to tighten interest rates at a faster pace and to maintain them there for longer than some other major central banks may have signaled. And again, I think that's something that the Fed is intentionally trying to convince the markets of. So I would take it as a positive signal.
Do you see weakness in the labour market, Blurina, creeping in? We've seen yields jump up on this data and the dollar on the rise, suggesting maybe the market's thinking we get more hikes from the Fed, that they're not seeing the weakness in the labour market that they need to see. Are you seeing any weakness?
That's a great question, and we just saw the claims data earlier. What we've been hit time and again is with this surprising resilience in the labor market and surprisingly strong momentum. Right now, I'm not seeing a lot of weakness in the labor market that would make me feel like a rolling over is imminent. So when I look at the payroll report coming out tomorrow for August, I would expect a significant slowing in the pace of job growth versus July. But then when I see the July pace of employment growth, it seems really at odds with what's happening in the rest of the economy, where the tightening in financial conditions is clearly having an effect and slowing demand and growth momentum. So then looking at the labor market going forward, I think this strength in jobs growth is bound to decelerate. And so I have that path going forward. The unemployment rate, I don't expect it to increase significantly. And then looking at and unpacking some of the survey data, we got the ADP report yesterday. That's been signaling since about late spring that job growth has been slowing in the economy. Looking at CEO surveys, the number of CEOs who expect either a hiring freeze or a firing has increased in recent quarters.
Blurina, so with all of that, tell me, what is the unemployment rate that you would say?
That's okay, Blurina. We'll let you go. We'll wrap it up if you've got a technical problem. Our apologies for that. Blurina Ricci there of T. Rowe Price.
John, I got a technical
my apologies for that
John, I got
too.
a technical problem. Can I go?
You've always got a technical problem.
Thank you. Okay.
You can leave whenever you like. Leave Anna and I alone and we'll work through the sterling move, Tom.
Trust Sunak.
Dollar strength off the back of this, Anna. What a move we're seeing again. Sterling breaking down. What are we at now? 115.52?
115.52.
Basically at the lows of the session. And Anna, yields higher as well. I think we're looking at 326 on a 10-year.
The market reacted quite a lot, didn't it? The market reacted quite a lot to that data that we just saw Mike McKee breaking down for us. And to your point earlier about whether good news is bad news and bad news is good news, well, this looked like good news that's bad.
Tom, I think at the end of the day, good news is bad news because good news apparently means this Fed's got to do more, and
John,
bad news is bad news because apparently this means
help me here.
This is the outcome the Fed desires.
John, if Afterthought completes her summer reading on time,
good news.
Is that good news is good news, or is that bad news is good news?
Good news is good news, but good news is bad news, Tom, because it means she's going to go to a good college, and you know the fees in America.
You know what's going to cost
$80,000 a year. You're going to get hammered.
Absolutely hammered.
Exactly.
It's good. Bad news.
Good bad news, Tom. Here's some
John,
good news.
I'm sorry. This is game theory. Alarian would tell you this game theory's baloney.
I know he would. We've heard this a couple of times, Tom. I think we've both said it. Other people have too. Where is Janet Yellen? Here you go, Tom. Next Thursday in Detroit, the Secretary of the Treasury will deliver, quote, a major address to discuss the Biden administration's economic agenda. I think that's some very good news, Tom.
Yeah,
good news on that front is good news. In a moment like this, we need to hear from the Treasury Secretary, don't we? I think so.
Yeah. John, 2 standard deviations technically on sterling is a 1.1518. We're not there yet.
Looking at this move on a 10-year too, Tom. Breach of 325 briefly.
Yeah.
324.76. Coming up, looking forward to this. Dan Skelly of Morgan Stanley Wealth Management. Daryl Cronk of Wells Fargo. Katie Kaminsky of Alpha Simplex.
Perfect.
To run you into the opening bell on Bloomberg TV. You want to join us, Tom?
Yeah, I'd like to do that.
Right, yeah.
It'd be good news or bad news. I don't know which.
Anna, thank you. I think we're going to catch up with you tomorrow as well. Looking forward to it as we guide you towards Payrolls Friday from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. The largest US airlines are now making more explicit pledges on how they'll treat passengers when they cancel or significantly delay flights. That comes after pressure from the US government. The Department of Transportation has unveiled a website publicizing airlines' plans. The carriers are promising meals and hotel rooms in some cases for the disruptions. President Biden wants voters headed into midterm elections to think more about Donald Trump and less about the economy. The president has been portraying the Republican Party as still being under the spell of his predecessor and his false claims about the 2020 election. Last week, he referred to his opponents as semi-fascist. Tonight, President Biden will amplify that message in a speech in Philadelphia. In China, the city of Chengdu is locking down its 21 million residents. It's a huge move in the vast western region of the country that had so far been largely untouched by the coronavirus. The lockdown could affect electronics and automaker supply chains. And a new report that UK households are set for the biggest squeeze on living standards in a century. The Resolution Foundation warned of a 10% fall in real disposable incomes over 2 years, unless there's a support package of tens of billions of pounds. Soaring energy bills have driven inflation well into the double digits. Add Jefferies to the list of financial firms that want their employees back to the office. Jefferies is asking staffers to come back on a more consistent basis to work through an investment banking backlog. According to a memo, the firm has no issue when employees need to work from home from time to time, but it wants senior bankers to be coming in to motivate their junior counterparts. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The earnings risk is now upon us, right? We're cutting numbers, and we think the numbers are going to come down even further over the next 2 quarters. So the bottom line for us is the PE multiple is wrong again, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook.
Best performance of the summer, Michael Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley, really has a high ground on challenging stock markets. Has done a great job there. We'll see where he stands here at the end of the fourth quarter. It's going to be really, really interesting. Futures negative 21. Anna Edwards in London, in for Bramo. John's off trying to get ready for the 9 o'clock show. It's Tang Free. Right now on a chart, Kriti Gupta. What do you have, Kriti?
Yeah, Tom, we talk a lot about currency depreciation, weakness in the Japanese yen, which of course is hitting a 24-year low, and also weakness that we saw in the Chinese yuan. The PBOC is now trying to push back. Instead, I'm looking at the Korean won, the key third player when you look at that trifecta. This is important when we talk about trade coming out of Asia Pacific, and specifically with this morning's story, Tom, on chips in particular. We know that the chip exports out of South Korea have actually dropped year over year. That is not good given the momentum that we are still seeing in the demand space. So my chart of the day actually looks at the dollar versus the Korean won, and we are seeing some pretty record weakness there, going back to levels we've seen in the global financial crisis, and Tom, before that, the Asian financial crisis. Not looking good for those who want to buy chips right now.
We rip up the script right now. As we talked to Anna Edwards earlier about Truss and Sunak, we're talking about the moment at hand. The moment in hand and away from the United States of America is emerging markets, and buried in the headlines of a busy, busy end of August is Georgieva to the rescue. This is the IMF doing it differently this time. Damien Sassower, with arguably his most important interview ever with us, Chief Emerging Markets Credit Strategist. Boy, are they early, and boy, are they tactical, and boy, are they surgical.
So we have seen just today alone $1.3 billion loan paid to Zambia, $1.2 billion to Pakistan. There's another $2.9 billion that's going to Sri Lanka. And we saw, of course, an 18-odd billion credit line offered to Chile to protect the currency around the constitutional referendum. So there's a lot of bear case to be made for emerging markets, but it's really tough to fight the IMF. It's like fighting the Fed in emerging market land. So, I'm not saying I'm bullish on emerging markets, but this is a step in the right direction.
When we see it, we're seeing an unraveling. Kriti Gupta talks about a powerhouse like Korea. Forget about that. I see Marcos Jr. takes it in the Philippines, and he's enjoying new Philippine weakness, and we can pick on 7 other nations as well. Does this have a 90s tinge to you?
Absolutely. No, I mean, look, this time, we've been waiting for the Asian central banks to finally, get the clue right and start hiking rates. So we have seen the Philippines, Indonesia finally raised rates, Thailand, you name it. But I mean, you're absolutely right to focus on the Philippine peso. weakest on record. Taiwan dollar, weakest in 2 years. You've got, the China yuan testing the 7 handle. The real, which is the strongest emerging market currency year to date, has failed to break through 5. It's now at 5.18. You've got the Mex peso back above 20.
Yeah,
I mean, let's go on and on. I mean, the rand is back above 17. It's currency weakness writ large. But again, the IMF seems to be getting the message here and stepping in, but not to the majors.
Damien, joining us from that emerging market, the United Kingdom, Anna Edwards.
You've just upset some people on Downing Street in the Treasury. Let me ask you, Damien, on that point, though, about weakness in currencies elsewhere and strength to the dollar. I mean, you've mentioned what the IMF is doing to help out those individual emerging markets that are really struggling right now. But what about concerted, coordinated action on dollar strength? Are we talking about that seriously? Every now and again, that subject raises its head.
Well, Anna, I mean, we have to start talking about it. I mean, I'm surprised that, the ECB, I'm surprised the BOE haven't started talking about it already. I mean, it's coming. Look, there's one thing that it seems to be kind of a staple throughout, the better part of the last 3 years, and that you can't knock King Dollar off its pedestal. I mean, it has just been ruthless. And so, look, 60-40 being dead, all that stuff that goes hand in hand. The one thing that's dead is non-dollar assets, equities and bonds. I mean, forget about it. There's no place for it in your portfolio if you listen to some of the experts here. So throw Markowitz out the door, Anna. Diversification only works if you're in dollar assets and dollar currency. So, I mean, it's a real tough job for portfolio managers, especially emerging market portfolio managers, to kind of allocate across this beta regime. I think what you're going to find are more people carrying in emerging markets, albeit on a currency hedge basis, to avoid that risk.
Yeah, one of your recent pieces of research, Damien, says passive fund flows signal renewed interest in EM debt. Where are you seeing that money go then?
Yeah, that was probably prior to this week, Anna. No, I'm kidding. No, I mean, we had seen, yes. I mean, for the better part of last month, I mean, all high beta assets sort of rallied, and emerging markets surprisingly so. Right. But now I think, we're on the other side of this. And, even though you see the likes of BlackRock, Proof, Fidelity kind of, scaling back on their bearish China calls, because, look, the whole pyramid is collapsing in China right now. I mean, that is, I mean, we've seen...
But Damien, I just because of time, I got to cut to the chase. It's the end of August.
Yeah.
This is not fun. I'm looking at the Bloomberg Global Aggregate Index price back to 2011 levels.
Yeah.
Why would anyone sane be in EM right now?
The market value of the Bloomberg Global Aggregate Bond Index is $59 trillion. It is down $2 trillion in the last 2 weeks, Tom. 2 weeks. I mean, like, it was coming back a bit there.
You've been great on this. Time and time again, people go, get into EM, get into international, blah, blah, blah.
More than 50% of that index is non-dollar fixed income. Think about that, right? So, the dollar impact is basically impacting, the global investable fixed income market more so than anything.
Do you get a jump condition? Is this stochastic processes where you're going to see real price down? Ecuador, Thailand in the 90s,
spreads.
Mexico?
The only jump condition I mean, we're waiting for it. It hasn't happened yet. And if you look at U.S. financial conditions, they've come roaring all the way back, right?
Yes.
I mean, so we've been waiting, and I think we're going to continue to wait. It may not be next month, next year, 2 years is what the experts are saying for spread widening. You got to look for spreads to jump in order for you to really get financial conditions to tighten.
Damien Sass, our sports guy. Serena all the way?
Oh, yeah. Did you see, by the way, last night? I mean, what a match. And by the way, the crowd, Bill Clinton, Dr. Ruth was there. Tom, I'm a big Dr. Ruth fan. You had Dr. Ruth, Bill Clinton. You had Tiger Woods was in the crowd. I mean, she was awesome. I can't wait to see. She's playing, I think, with her sister, right? They have a doubles match this evening.
I think so.
Wow. I mean,
Damien Cesar, thank you so much. Anna Edwards, did you survive today?
I survived today. I survived better than Emma at the tennis.
Well, that was, I was way up high. I had it, Damien. So with Emma, I had binoculars so I could watch Mets-Dodgers at the same time over the rim. Yeah, it was great.
Strategic.
Okay. Anna, you're going to come back tomorrow?
Oh, I'll think about it.
Okay. Anna Edwards, tomorrow for Jobs Day in America. Please join us. Futures -24 on Bloomberg Radio and Bloomberg Television.
Welcome back to another special U.S. Open update for Bloomberg TV and Radio from Tennis Channel. I'm Johnny Ray Diaz. The Serena Williams Farewell Tour continues at Flushing Meadows. The 23-time major champion came through a thrilling 3-set victory over world number 2 Anett Kontaveit to reach the third round and put at least a hold on her retirement from the sport. But the fans inside a packed Arthur Ashe Stadium want Serena to go on and on. Earlier, Coco Gauff also advanced with a straight set victory over Elena Gabriela Russa. The American has now won 10 of her last 12 matches at the Slams. Up next for her, compatriot and former finalist Madison Keys. And don't forget, Tennis Channel Live at the US Open has all the news you need from the Big Apple. It airs daily at 9 a.m. Eastern. I'm Johnny Ray Diaz.